Big, and I actually do have a question. When is the best time to take splices for the next day? Is it right at close?
Well, it really can be done both during the static market and during a live market as well to kind of look if, for example, I mean, it's kind of it's dependent on what you're looking at actually, because if you're looking at something that's, a week in the future, we could have a significant gap between that period and the current period. And so what I like to do is more so I like to look at splices in like kind of a group of days, meaning like I'll do, Tuesday, Wednesday or Tuesday, Wednesday, Thursday, and then I'll kind of like have it so that one of those days is the active session, right? And it doesn't have to be open necessarily, right? It could be both static or open, and that could still be relevant. I don't know if there's necessarily a best time because it's not like there's no repainting going on, right? So the graph is like, an accurate back test of whatever you're trying to look at.
Can you guys see the splicing thing I've got up?
Yes, we
The
can. Thank you.
screen share? Okay, cool. Yeah, I appreciate everybody being here. So I'm gonna explain this stuff from a different level, and then I'm gonna show how this works, and it's really valid for options. Because of the way the options work, the options market. It's like has crazy upsides to it. Um, so basically on our splicing, it's nonlinear data analysis. And all the retail systems out there, it's always linear data, which is fine, but linear data is not a real good representation of what's going on in the market. Um, so the splicing, basically, I've kind of cut and paste a bunch of stuff, but it's like I was saying, it's nonlinear data analysis. So it's a statistical method used to model relationships. And when you open up a splicing graph, it's actually using like AI tech. I hate that word AI, but it's using techniques that um, figure out the relationship in the data. And what it does is our system's like it's combining a neural net and some other stuff to show the data to us. So it's like a raw interpretation of what the market's doing. And with that, we can use inference to figure out things we can do to take advantage of that. But, so it's not a straight line when we do splicing. So it's showing a relationship. And I'm going to use an example of Monday on QQQ. I use QQQ just to kind of like, train to show people how to implement stuff. And the splicing, I hardly ever show it in the QQQ live. Just sometimes I'll show a little bit of it. I usually do that for myself in the background. But anyway, so unlike the linear analysis, which that's proportionally between data points, the nonlinear uses a variety of techniques. So the fundamental core part of this is the vector, the learning vector. And with the learning vector, it starts to create everything else our system uses because it always uses that learning mechanism. And I'll get people asking me like, is that vector in the system the same that is on TOS and TradingView? And it's not. The one in the system uses a learning model. So it comes up with a little different values. Um, the ones in TOS and the one on system at the purple vector. We're using these nonlinear regression techniques to create our models for the splicing. And so the difference is on the linear data structures, and that's what all the retail systems use. Um, mainly they're basically a linked list or an array. So as the data comes in from the exchange, they stuff it in an array or a linked list, and we don't do that. So what we do is we start with the linear data, and then we start to create our nonlinear trees for the fractal system and for our splicing within the fractal system. So the nonlinear stuff here, they use the word artificial intelligence again, but it's just basically learning models. So what we're doing is we're creating a learning model when we open up splicing graph. Any fractal graph is a learning model to start with, and then the splicing is just another learning model on top of that. And they have some examples here for processing and graphs, trees, maps. So the nonlinear data type, and I'm trying to do this for a level set, so we're kind of on the same page, even though like maybe some of this stuff doesn't make any sense. At least first there's exposure to it, and then over time you kind of start to understand it a little better. But the nonlinear data structures we're using, basically nodes. So when we're opening up a splice graph, we're looking at, or even a fractal graph, we're looking at nodes, relationships of data to each other. And here it happens to be price and time. So, it can be for image processing, it'd be something different. But here it's price and time. So it becomes a tree structure with leaves, child nodes that are connected to the parent is what we start seeing in a splice graph. And so uh, the difference between nonlinear and linear is linear gives us like a massive advantage because we can start to see nonlinear gives us that a massive advantage because we can start to see the market relationships in a way different visual than we can on a linear graph. And I'll show how that becomes important down here in a few minutes. So here, for example, they're saying the different types of learners prefer either linear or nonlinear learning approaches. The linear learning follows the fixed order of steps. Like when you're looking at an analog graph of the market, time and price, there's always a connectivity between the time and price, because there's always overlap in the data. Like it doesn't jaggedly move up or down. It's like always overlapping the highs, lows, close prices and stuff. There's always some overlap. And the nonlinear is dynamic and it looks more chaotic and random, but that's actually how the market's moving. So the linear learning, as they say, is structured and organized, while nonlinear learning allows for flexibility and creativity because it's just really showing you how the market's truly moving. I'll show you how that works down below. So the four types of the nonlinear functions. So in mathematics, we have the quadratic functions, we have the polynomials, rational, exponential, and logarithmic. So we're bringing a lot of that stuff together into the graph visually, so we can try to make heads or tails of it. So our system, again, I don't like black boxes. Black box is where put in a bunch of stuff and it spits out something like a number, like 10. And it's like, so when you're putting in stuff and it spits out 10, it's like, well, that's great. It spit out 10, but how do you get to 10? So the system visually is showing us how it's arriving at its conclusion. So we can look back left because the left side of the graph is the back tested side. It's always showing us how it's back testing and how it's deriving and figuring out things. And then that leads us to the bleeding edge of the graph on the far right where it's not been written yet. But we need to have an idea of what could happen so we can exploit the market and ideally make money off of it. So here we're, using these nonlinear functions to figure that out. The four types of linear structure. So if we go back to linear, which is what, in retail they use, and the shops, when you're working at an institution, like, and there's multiple types of institution. Even Apple has a huge, they manage their money and stuff. So they have a lot of analysis internally with their guys. The Mormon Church has it. And then you have like, Fidelity and all these brokerage companies and stuff that are trying to manage money and hedge funds and stuff. So, but anyways, there's a lot of, usually most shops are writing their own software. They're not using retail stuff. It's like stuff we're doing. That's the kind of stuff they'll be doing. But anyways, on the linear, again, it's sequential manner, and it tends to be in array, stack, or queue, linkless. And that's not how we represented the data. So when to use the linear versus nonlinear. So in general, the results from nonlinear simulation are always more accurate. Again, the fractal system is nonlinear. The splicing is nonlinear. Um, and the rationale, I just cut and paste from Google, so it collects this, but the rationale is that the world is nonlinear. It's like preemptive. You get a call and it causes you to derail on the task you're on. Or you're driving down the road and then a driver swerves into your lane. So you preemptively change lanes or take action. The market's the same way. As all this information's flowing into it, it changes course. So it could be going up and all of a sudden Trump tweets and it goes down. Or, there's an attack or something happens and then it changes course. So, which makes it hard because, like, when you're on a trajectory and all of a sudden it flips, you're like, oh my God, what happened to my trade? It was working, and now all of a sudden it's in the red, or, it's going the opposite way. But that's how the world works. It's preemptive, things just pop up. Linear analysis, it's a simpler way to looking at the market, but it doesn't really give the oversight. Like, I like to trade options. So I like to try to find stuff that can give an edge, give a better overview of the market. So, now one problem with nonlinear analysis is speed. All through the 90s, when I was doing this stuff, well, most of the 90s, the computers were way too slow. I would use mainframes a lot. So when I was doing stuff, I'd be like connecting PCs into mainframes, and they would be doing the number crunching because of the bus and stuff. They didn't have all these issues that the PCs had. But now the PCs over the last few years have been catching up. So it lets us open up these graphs and stuff really fast. Before it would take like 2 hours to open a graph. I mean, it's just like unusable. But now that we're in the gigahertz, it's a lot faster. So because of this processing speed, we can do more fanciful things more cheaply. We don't need thinking machines, array mainframes. We don't need all that anymore. So the criticality here is, can we predict the future, right? Because if we can predict the future or some semblance, being good enough, being close, we don't have to be perfect, but if we can kind of predict it generally, not being perfect at it, but just generally predicting it, then we can win and we can make money. So can the nonlinear graphs predict the future outcomes? So using nonlinear regression, we can offer insights into complex relationships. The splicing does that, such as predicting here, they gave an example of population growth over time. So whenever we're doing this stuff, we have to pick the right regression model. So I pick regression models that I know are proven to work. And I build them, this math, all this calculus and stuff. It's not from books, it's stuff I've built up from scratch. So, you can go to school, university, college, high school, whatever, and you're being taught math in a certain way. I kind of break from that. I don't do what the norm is, what's classically been taught. And, a lot of times in school, they'll be like, oh, standard deviation, do it like this, do it like that. And everybody's like a sheep. They just follow along. Okay, great. That's how you do it. There's flaws in standard deviation. I don't even know why they're teaching it the way they do, but there's inherent flaws in it. So anyways, we break away from that because we need a a look at that market in a different way, and we don't want to like necessarily follow the herd. So we try to break away from that, looking at it, getting a different view of it, and in a few minutes we'll see why this can work. So in the fractal system, it will predict certain outcomes, and I'll show you how to figure that out. So the main thing is, in school you'll be taught the KISS principle. I know in college, like, KISS, keep it simple, stupid is what they would call it. There were teachers hammering away at this. I had one guy who's actually a really good teacher. This guy, Kirk Warren. And he was always like, keep it simple. And if you can't do it on paper, you can't come to the computer and do it on the computer. So if you can't figure out, and the computer here helps us in trading because it can crunch a lot of data. But if you can't figure out how to do something on paper, the thing is, it's like invalid was his thing. So what we try to do is we try to keep this stuff simple, even though it's doing a lot of complex math and stuff. We're trying to keep it simple, and I'll show how to kind of keep it simple so you can literally do it on paper and transcribe it from what you're seeing on the screen. Now, for the splicing, the most simplistic thing, and this is the thing to start with, because later on the system, I'm going to port more code over. It's going to get more, it can get more confusing with the different splicing techniques we can do. So right now, the first thing you want to do is just keep it super simple. I'm going to show Monday splicing. I'm going to show how to open that up and how to read the graph. And I would advise, because you got to get this stuff straight in your head. So the first thing you want to do is just keep it super simple. So to do this, use wave 1 daily and select Monday for the splicing. Now to do that in the system, you right click over the symbol, you click add, and then you'll get the little box that says, okay, what symbol, and type in whatever symbol you want, but I'm using QQQ in this example. And set your aggregation to daily wave 1, because you're training this system. So you're training it on what you want it to use. And what you want it to use will determine what this outcome it produces is. So in this case, we want to use, we're using inherently by doing this, we're saying wave 1 daily, which is the closing price. So when we do it this way, we're saying, okay, we want to evaluate closing price. Now, there's a little tab in there, splicing. So you want to do QQQ, wave 1 daily, splice on Monday. So click that on, and then you want to click the button, add wave 1 daily 200 DTL. And what that will do is in the symbol list, after you hit close button, you're going to see QQQ wave 1 daily 200. And what that means is it's tracking close to close to close, because the vector in the system is always going off the last price. So the vector is always tied to the last price. So when it's learning based on the last price. It's not using the high, low, or open. It's always using the last price. So that will tell it to use the last price and evaluate it on a daily basis on Mondays. And when we open the graph, on the left-hand side, we're going to see fractal, splice, and we're going to see Monday. This is showing what the system's learned. So again, it's nonlinear data. That's why it's so bouncy up and down. It's not linear. It's nonlinear, so it's going to be, there's going to have displacement, looks like gaps up and down in the data, because it's showing us relative Monday to Monday. Now, what's important here is we can see most recently on the left-hand side, we see this average short area I've added to the graph. You can see on our Mondays, when we get into that green area, it's supportive. And then the next Monday, because this is Monday, 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 Monday. So one of the Mondays, we don't care what day it is, but one of the Mondays, we have an L1. It's kind of in the center of the graph that went into the green, which is the supportive area. And then we bounced out of the green and went up. Now, if on that Monday at close, you bought into the trade for the next Monday, the next Monday's close price would be higher than the prior Monday. In every one of those instances, we were in the green. Now, on the left-hand side, the far left, we fell out of it. We weren't even in it. We had one red candle that went in there and touched it, but then it dropped out. So I'm going to show you what that looks like. Okay, so here we're seeing that we have Mondays that are successively higher. Now, what I'm focusing on the most recent Monday, the October 20th and the October 27th Monday. So on the far left, or excuse me, the far right, we have October 27th Monday, the little green kind of squatty candle on the far right. So that shows our price action. Now, that's October 20th. Now, from October 20th, what could we expect on October 27th? I mean, we can look at the graph, and I look at it and I'm like, I can see that we're having successively higher prices. I don't know how high, but I know that it's going up. I know from Monday to Monday, we're tending to go up to at least a 2H. So that means there's 2 days, 2 Mondays above the pivot with a higher high, like a higher close price. So I know that if we're to 1H, we did have one failure here. There's a 1H and then it went to the 1L. But I know that if we're to 1H, I have a pretty good shot at probably getting to an H2. So to figure that out in that options analyzer, because I like to do a lot of options, I can see here statistically that we have a 67% chance of going to H2. So I know if I put on, I know from October 20th, if I put on a trade long that's below October 20th close, that it has the propensity to work out 67% of the time. So that means out of 100 trades, statistically, 67 would work. So it's approaching 70%, which is really good. Because anything above 50 is great. And in the option market, it can return really unusual results, on the long side. So, like I was saying, when we advance to Monday, October 27th, we have price action above Monday, October 20th, and it heads near the top of the red line average. So you can see on the left side of the little graph, we had the Monday on the 20th down here, and it jumped way up heading into the top of the red band. So a lot of the times, by definition, bulls want to seek out the most recent high. So the market itself, on the bullish side, you're always trying to get to the most recent high and get above that most recent high. So that's your goal in life, is to try to climb. You want to go up, you want to go up, you want to go up. The bears on the flip side want to go down. They want to go down to the most recent low and below. So since our fractal data is nonlinear, it's showing us in an unusual way where the high's at. So we can look left and we can see, okay, where are the last highs? And we can see our little candle patterns of where they're at. That gives us an idea of how high we can climb, of where we can go. So we know about 70% of the time we can go up. Now, another part, okay. So this is using inference because we're inferring that the bulls want to try to go to the most recent high, and we do it in a nonlinear fashion. So they want to go to the most recent high on the left. That's where we look to. So we're using inference for that. The whole system is inferring where we want to go, and it's inferring that 67% of the time, approaching 70%, we go up. So the system's machine learning. So in a machine learning system, the inference is a process for using the pre-trained model. Okay, that's when you set up wave one daily Monday splicing. So that's your model. So it's making predictions 67% on unseen data, right? It just has the historical machine learned information, and it's showing that to us in the OA is 67%, so it's approaching 70%, so it's unseen. So that's the second phase. The first phase was the training when we open the graph. And so it's taking that knowledge, what it's learned, and projecting it. It's projecting it through the options analyzer. And so it's learned that 67% of the time we can go up. So approaching the 70%, that's true. This implies looking at the subsequent Monday can do the following. So on the graph, okay, so logically when we take this to a trading graph, like let's say we take it to TOS or TradingView or whatever, you can draw a line on October 20th, Monday close price. That means if the 67%, so we're approaching 70, almost 7 out of 10 trades work, anything beneath that line is a buy. So when you mark the Monday, the October 20th, anything beneath that Monday's close price would be considered in a buy zone, because 67% of the time we have the subsequent Monday's close, the 27th, above the 20th close. So that means as we dip down, it's a buy zone. Now, that's great and all, right? But how much could it go up? So when we look at the little histogram, it's showing us our wave sequences up and down, and we have an average of 6.8 up. Now the average is made up of all the little minuscule moves and the big moves. So it's just a representation of what those would be averaged together. 6.8 from that close. That generates, the histogram generates our levels. So what I do is I unclick the lock mouse tracking, and then I can move up and down across the histogram. Because again, I don't want to black box this thing. If I'm wrong, I want to be wrong myself. I don't want it spitting out like the number 10, as I was saying. So what I do is I unclick the lock mouse tracking, and I can move the mouse up and down and see the percentage change. So I see on the low end, we're about 2.3% on the lower end of a move. So that means October 20th close, we can be 2.3% above that. And so that gives an idea of where we could go at a minimum. So what we're doing is we're treating this like a casino. We're counting cards. So we're getting a house edge. The house edge is at 67%. So just like in a casino, the odds are always in the favor of the casino. They're not in the business of losing money. So with this advantage of how we're looking at the market, we can set ourselves up to participate with the overall market and apply that idea to the market. That means on October 20th again, if we mark our close price, and when we dip below 67% of the time, we're going to be on the 27th, on the next Monday, 67% of the time statistically, we've been above that line. That means during the week, so Monday the 20th, during this week, from Monday the 20th to that Friday, is a buying opportunity. So as we move down, we can look at buy side opportunities. So here I'm showing a call option. And this is like freaking insane because knowing this information, like let's say we pick 625 strike, and you can be like at the money, you don't have to be like way up above, you know. I showed up here how we can resolve for price using the histogram. But let's say we did use the histogram, you can see what this can do. So a 625 strike for the 27th, that Monday the 27th, had a low of 6 cents and a peak of 350. So the low at a $6 call running to $350 is pretty crazy. And the fact that we can predetermine that that's a possibility, you know, puts the house odds in our favor. Now, and then our vector, you can see why we color code and why we use the vector. Because here I set it up for a 30-minute aggregation. So I can see where it's, so on the far left on that TOS graph is Monday. So you wait for Monday's close, right? And then the next day kick starts this whole process on Tuesday. So you can see we went red. And even if you're like super excited because you're like, oh my God, Russell's showing me this. Now I'm going to come out on Monday and I'm going to go crazy on this thing because I'm going to be so rich by the next Monday. It'll be incredible. But even on Monday, if you made an early entry here, you can see it still made money. So if you know, it's like if you're very impatient, you can still, as long as your call isn't too far out of the money, like too insane up there, like let's say you're near the money, you can still come out positive. You can still come out with a win. But you can see here, if you're patient and you're trading Monday to Monday and not all crazy, because sometimes I know you know, in some discords, you know, be like, oh my gosh, I bought this at 20 cents. I sold it at 28 cents. I feel like I had a big win. Well, imagine if you're down here at 10 cents, 20 cents, and then you're up at 350. I mean, the risk here is just incredibly low. Is you're looking at like a visit to McDonald's for 20 or 30 bucks, you know, to come out with $300 or 200 or 350. So very low risk. So again, in our model, this becomes that buy zone area on our splice graph by putting in the green. And then if we have a green candle, by definition, the peak price will be more near the close of the day. So that means as we start the day at 9:30, you know, and we have, let's say we have a green candle on that day, the high price you'll get will be more near the 3 p.m. time frame. So it takes, you know, all day. These things are getting really warmed up, getting juiced up. So you can see October 20th here came down, buy zone, 67% of the time that works out. So here, the key things are knowledge and fear. So if you have knowledge, you know, you have the personal and professional growth, you have informed decision making. So the system is for decision support, problem solving, and that lets you have innovation in your trades. You know, you can come up with things that other people just have no idea about and can't see. So, and as you do this, you get, you know, better skilled at it. And you also lose fear, you know, because the biggest thing in this is fear. If we go back here and you're at $6 and you're like, how in the world can it be at $3? That's like just not going to happen. You know, it does happen. And So losing that fear, because this trade's about going from Monday to Monday. And I mean, yeah, sure, you can go in at like 10 cents and try to take it out at 20 cents, but the big reward comes on Monday. So managing that fear, um, and not having the analysis paralysis. And a lot of the times, I remember there was a guy that came in here, not to name names, but JD, he was asking like so many academic questions about, win rate and, like just, I don't know, just a bunch of different stuff. It's like, that's fine. And you can quantify what's happened in the past, like the options analyzers giving the basic view of it. 67% of the time this trade works. And you can get, I see on, I use, oh, it's out. One service Cura. I'll go in there and read through sometimes and post a little bit here and there. Guys in there are killing themselves like back testing. I've never seen anything like it. You can back test until you blue in the face, and it still, the market will do what it wants to do. Here it's showing us what's been happening, whether you believe it or not, or want to buy into that idea. It's analysis paralysis. And so when I build systems at a corporation, institutions, this is a big thing, analysis paralysis, because it's always, we do a lot of stuff. We have what they call BSAs, business systems analysts, and we go in there and create all these, things, analysis paralysis and cons and pros and how things should work. And it's important not to get stuck in analysis paralysis, because once you develop the information, then you just act on it. And if it doesn't work that time, it'll eventually work out, because the market's not always stuck in one gear. And you can see the upside. Like, let's say you tried this trade 2 times in a row and it failed, and the third time it worked. Well, if you're in at 10 cents and you get out at $1.50, I mean, as long as you don't put all your money into one trade, it'll work out over time. And that's one of the keys, is like not overcommitting and then wasting all your coin on one trade. Want to keep your powder dry, as they say. So the one fundamental rule is, when in doubt, just buy one. Like if you're trading contracts, you would just buy at least one of them. So there was this guy that I worked with. He ran a multi-million-dollar hedge fund and all this stuff. And he was like, the biggest mistake traders make, they get in this analysis paralysis, and they won't even buy one of something. And the trade goes off in their favor. And then they're all like kicking themselves because they didn't buy at least one. And again, on a failed trade, the market generally, unless there's insider trading going on, has the same information we have. Citadel has a little more information because they're clearing transactions for people. It's not exactly a fair fight. So I do have a little bit more. But for the most part, you could say it's, market is kind of sharing the information it's got with everybody. You don't want to get in yourself a situation to lose everything in one trade. So we did NVIDIA back in April or whatever, and it was, supposed to go to I don't know, 80 or something. Whatever it did, it got there. It was like I think about a week later than what I'd calculated out. 1 or 2 weeks later, maybe a week later. And then the next target's 232. Well, I know people were DMing me. They put like a massive amount of money into those calls I was first showing, not considering that we may not get there in time. They were over leveraging. And it's like, that comes out of pure greed. It's like you can just take a smaller amount of money, go into closer, near the money contracts, and come out okay. And, because if we don't hit, like, let's say 180 in time, then you just get trashed. So it's like not to go hog wild, and always, you want to consider the flip side every time. If this trade fails, will it kill me? Because active trading is not easy. It's like not every time does a thing work, of course. It's all driven by new information coming into the market all the time. And sometimes that new information is not the direction we want the market to take. But again, so we're trying to use the trend on our splicing to figure out how to pre-position it. And you can see below, there's a lot of people I know in here. Some people do prop firms. I always do cash accounts and stuff because they take your money away. Basically, you get penalized for using that stuff. And if you have a lot of money, it doesn't really matter anyways. But these, you can see here, for just a small amount of money on our options, you can build quite a bit of capital over time. So it's just a matter of trusting in the process and not wasting all your money on one trade. So that's about all I.
Thank you, Russell. Now would be a great time regarding questions on anything Russell's shown with the splicing stuff. If anybody has them, you can either chime in or just put it in the chat.
I've got a question. You mentioned at the beginning, keep it simple. What were some of the other advanced ways that that you can splice?
So you can start to do multiple days. Are you doing like Monday, Friday, Tuesday, Thursday? So you can start to combine them. And it starts to get like you got to keep it in your head straight. It starts to get confusing because then, if you're doing like Monday, Thursday, you're like, oh my God, what am I looking at? So what I would suggest at first is just to do Mondays. The system also does splicing on events, on ERs and other things. We just don't have it turned on right now. So what I would suggest in the interim is to splice like Monday, splice on Tuesday, splice on Wednesday, splice on Thursday, splice on Friday, just to keep it single days. And then you can start to do multiple days. And then when we turn on the events, then you can start to splice on ERs and stuff and on other events. But right now, because this is not really on the retail side, you can go out and search and never find anything on splicing. It's not really shown, and so I would, all the information comes out of us for splicing, right? So I would kind of just work on a single day at first so you can kind of get that straight in your head. And then as we turn on other features or you want to do more days, go for it. But yeah, at first I would do, like Monday's like a giveaway. You can see the power of this for just Mondays, So Fridays is awesome. Like I was showing before I left on vacation, I was showing I forgot what trade it was. It was $2 to $3. And then on Friday it went to 23. And I was just using splicing. I was just using simple stuff for it. So the 23, so $2 to $3 on an option is 200 to 300 per contract. And at $23 an option is 2,300. So in that case, $200 to $300 became 2,300 for every contract you bought. So if you go 10 contracts to $2,000 or $3,000 to 23,000. So it's pretty potent. Yeah,
We had
so
a
splicing on Fridays is awesome.
we had a couple
Sorry.
other questions in the chat. One said on the splicing, is Monday your favorite to use or just a random?
So Monday's, well, really any day, but Friday's awesome because if you get into options, the time decay comes out of them. And the upsides can be incredibly awesome. Like Tesla, I've shown Tesla a couple times, but there was a trade like probably 2 months ago in Tesla on a Friday, maybe 3 months now, and it went 11,000%. So for every dollar in, it was 110 out. So you put $100 in, it's 1,100 out. It's just like, so Friday can be real magical. And it's all up to the whatever you're doing, depending upon how much premium's in it. But yeah, Monday, Friday is good. Those days can be pretty good.
What about
So
like a combination of the Monday Friday splice to kind of like represent like a weekly open and close?
yeah, you can. Yeah, you can do Monday, Friday too. If you do Monday, it's just for me. Sometimes I'm like super simple. I just even though I build all this math and stuff, I'll look at it like, oh, what's going to happen? Monday. Like, what's been the prevailing outcome? What's been the trend? There's that old saying, the trend is your friend. So I'll just splice Monday and not try to get too fancy with it. But yeah, you can do Friday, Monday. You know, Tuesday, Thursday. You can do all kinds of stuff with the days.
We have another question. Are splices on lower time frames, say wave 7 60-minute for each day, a good use of time, or just keep on the daily?
Yeah, so you can do the smaller time frames and the waves. The advantage with the daily is it can sample a larger amount of data. But yeah, you can do smaller time frames. You can do like 760, you know, um 520, just whatever you want really. And splice. But the key is you're across many days. So some of the data that the provider gives us, like it doesn't have a lot of historical. So if you open like a 760, you may only get 50 days worth of data. So it won't be like a big representation because the system has to build a model. So it likes a lot more data than a little bit of data. Um, but yeah, you certainly can. I have no idea how to open the chat on this.
Oh, no worries. I'll read them off to you. Harry says, why not EXT versus RTH? They hit on those open states, but do they not matter? Question mark.
Yeah, so since we build our data sets off RTH, for them to be like open states, for example, for them to be closed, they do need to occur in RTH. If they don't occur in RTH, they're not considered closed. Even though, as you say, Harry, and as I see myself too, they will be hit outside of RTH. So in extended hours, yeah, we'll be hitting them like a dog. I mean, these things will be hit left, right, and center, which is great. It's just to close them, we have to hit them in RTH. Now, one reason, so the fractal system, it does run in extended hours. It's turned off. And one of the reasons is the extended hours, since there's not a lot of liquidity, it's very choppy and it starts giving a lot of data points. So right now we just have it set to RTH because it just the amount of noise that starts being entered into the system using the extended trading hours becomes ungodly. It's hard to manage. Sometimes I turn it on for myself. I'll enable it for myself, and it's like just because I want to see, sometimes I trade after hours and I want to see if we're hitting things. So sometimes for myself, I'll turn on, but generally I always leave it off because it's just so the option's not in the software. It's something I set myself over here, but it's just really choppy because of that liquidity. But yeah, you can, if you put in your open states and you call them RTH and maybe EXT open, and you check off the extended open or the extended hours, and then leave the RTH on. Because the rule of the road is, since it's RTH data, we have to close and open during RTH hours. But you can add the open lines and just designate them as XT, EXT, or something like that in your trading graph.
Thank you. The next question is, how do you look for trending stocks like the recent AMD, among many others? He had his eye on it before we had a K on the standard deviation.
Yeah, so what I'm watching is that standard deviation line in the software is really, it's a key metric because generally all moves start at compression. So moves start generally at compression. The only other place a good move can start is after radical expansion. And those are all that matters in a trade is, are you on the compression or are you on a radical expansion? Everything else is in the middle. And when the trades are in the middle, it's hard to grind out money. And you can see for yourself, like on the screen, the vector, when it went green here on Friday, Monday it shot off. So that was showing us that the compression, this vector actually is a measure of compression. So when the vector and the price action start to meet up, it's compressing. So it's implying, it's showing us something's going to happen. But in the software, that thing shows the compression on a single line, both long and short. Now, in normal standard deviation, it's negative deviations, positive deviations. The reality of it is the deviation's just one way. It's either compressed or it's expanded. There's really technically no negative or no positive. So it just shows it up on one line, like, are we compressed or not? Now, when we're compressed, and let's say we're running an M, being me, I'm always looking like, oh boy, where's it going to flip to a K? Because we're running an M, and I know it's going to flip to K. Now, in my mind, the question is, when it flips to that K, are we going to have a radical move? What I like to see is, I like to see price action underneath the pivot, because we're normalizing our data on the fractal system. So, under pivot short, if we're short, we're an M compressed. So we're down in the golden zone, heading to the golden zone. I'm like, man, when this thing flips, are we going to shoot up through that pivot line and jump above that average percent? Like, I'll set up my graph sometimes at that average percent. Are we going to be able to eclipse that and get above it? So I'm looking at what's next because we want to use inference. We're using it in our head. We're not letting the system tell us what's going to happen. We're watching it because part of the thing with trading is it's like playing a sport. It's reading the price action. We're an M, we're under pivot. When we flip to K, whenever that happens, are we going to fire off long, and have a really good expansion of price long? Because that metric down below is showing us our expansion long and short. So it's like we can look left and see how much expansion can be in price. We can look on the fractal graph and see where our imprints have been. So for me, it gives a mental picture. Okay, traders have been taking it up to these imprints. We're an M. We can flip to K. If the macro is green, all the better. If it's red, I know the macro's red. I know it needs to flip to green. And some of the most freaking potent moves, they're just like crazy, is when the macro's red, we got an M, we're below the pivot, we flip to a K, and the macro goes green. So what I like to look to also is that ribbon on the macro. Is the red area, length of the red area, kind of similar to the left-hand side? Because I'm trying to gauge it. So I'll look to that macro and be like, okay, have we got about as much red as we have on the other left-hand side, the back testing reds? Because the whole thing with trading here is, it's a discretionary decision. Is it, we don't have anything telling us precisely when to get in, when to get out, but we have these metrics that are hinting to us what the momentum is in the market and what the potential direction can be. So at M, I'm looking flip to K. So I can see like if AMD may be ready to fire off long or may be ready to fire off short, or any other stock, of course, or ETF. Also works on futures and everything else. So kind of reading that price action and then getting ready for a potential flip. And this is another thing. So on the QQQ Live, I'll put in a line. And I'll put in a line being like, okay, this is the, I don't know, average percent line. And maybe we're on the red average percent. I'll be watching the vector in there to see if we're going to like on the call, to see if we're going to start to transition green, right? So I'm trying to pre-think what can happen to it's like playing basketball or football or whatever. You need to be on the right spot in the field, on the court for the ball. And that's the same thing here. We're looking ahead, saying to ourselves, where are we going to be an hour from now, a day from now, 2 days from now, 30 minutes from now? Where's that price action likely to be? So we're using these indicators and gauges and stuff to kind of guesstimate that, to figure out, and it's using smart techniques, AI techniques, right, to kind of quantify this data for us so we can get a picture of what can happen. And that's one thing I liked about the fractal graphs. Like, it drives, when I go on vacation, I can't get to the system. I go berserk because I'm like, I can see all the linear graphs I want. I don't care. I want to see these cycles. So it drives me when I was over there, I'm always having to check the fractal system to see where I'm at, even though, it's easier to go to Yahoo or whatever, or Google to get graphs. It's like, I don't care. I want to see where the positioning's at above or below the pivot to give me an idea of how the traders are treating price action. But yeah, it's kind of a long-winded thing, but I don't know if I answered your question, but kind of looking for resolution to a K and near the golden zone to gauge
Thank,
some of this stuff.
thank you, Russell. Another question was, so the percent chance of it working out for the next week is just looking at the options analyzer to see the chances of forming the next HRL value. Could you show how you would do it for next week? So like a live demonstration.
Yeah, so let me see if I can share. Oh, Lord. Okay, I think I got to stop streaming and restart it.
Yeah.
Let me see if I can share. You see the graph? There should be
Yep, I can see it.
this fractal graph up.
Looks good to me.
Okay. So this is for Monday. If I move my cursor, which is taking forever. Okay. So I'm on 10/27th, which is last Monday. So where do we expect the market to open, or excuse me, where do we expect the market to close tomorrow, November 3rd? If I go to the options analyzer, you can see that on an H2, which was last Monday, we were at 67%. Only 33% of the time, which is tomorrow, Monday, do we close above last Monday's close price. So right now there's what, a 67% chance at Monday. So there's a 67% chance that tomorrow's Monday can close below last Monday's close, which is 628.09. And where did we end up Friday? Let me check Friday. So on Friday we closed at 629.07. So we only have a 33% chance of closing above 628.09 tomorrow. Cents. So, because we're splicing on Mondays, the 20th to the 27th, we moved up. So we closed above, which is over here. So the 1H is right here at 100%. So from here to here, we had a 67% chance to close above, which we did. Now from the 27th of October to November 3rd, we only have a 33% of the time have we closed above statistically. So Monday tomorrow, that means we have a 67% chance of closing below last Monday. That means if that happens tomorrow, then we would have an L1 assigned. Because on this graph, the close price becomes the vector, since it's wave 1 daily. Because it figures out it needs to use a close price. There's nothing hard coded, it just figures it out. So the close price becomes the vector. And that means that tomorrow we have a 67% chance of being down here with an L1 closing below last Monday. And it's a statistic, so it doesn't, like any statistic when you're trading to a statistic, doesn't mean every time it has to play out. But the house favors a close below this 628.09 tomorrow. Right now. That's been the trend of the market. And something could, of course, change that trajectory. If we get some information in, it might change it, but statistically, it should close below 628.09. Now, what that means is we don't want to trade blindly. I still use the vector. I'm still watching, like I'll come in here and on QQQ Live, I like 10:15 for intraday. And I like 25 also. So a lot of times I'll either use 10:15 or 25. Wave 25 minutes. So it's just showing the cycles up and down. So what I'll do tomorrow on QQQ Live, like usual, I'll put in the vector. I'll put in Friday's vector of 630.60. Right now, on Monday, if we open beneath 630.60, the market is short. and it's going to try to cycle underneath the pivot. So when the market starts up in the morning, you're like, God, I have no idea which way it's going. I don't know if it's going up or down, left, right, center. I have no idea. Look at the purple vector. When the price is above it and the market starts up, it tends to stay above it. When the price is below it and the market starts up, it tends to stay beneath it. So I'll put the vector in, and as we have the pre-market data injecting into the graph, if we're above or below that purple vector, that tends to be the predominant direction. And the way we know that is when we look at the fractal system, we go back and look at the left-hand sides. And you can see on this day, on the 31st, I know these are, especially when you're new looking at this stuff, it's like, what the heck am I looking at? But anyways, we opened above the purple vector, came down, dipped down, rallied back up, and eventually broke beneath the purple vector and then went underneath the pivot. So when you're trading like me, and I'm looking at this, and I'm looking at wave 20, 5-minute interval, for example, I'm like, I see the price cycling above and below the pivot line at least once, twice, or 3 times a day. That sets my head straight. So I'm like, okay, I'm above the pivot. Great. I know it's sometime during the day. I don't know when, but we're going to price cycle beneath the pivot line. Now, then the next question comes in, will we have a deep enough cycle beneath the pivot line to make the put option, like if I'm trading a put, decide to trade a put, to make it be of a good enough premium above what I paid? So, of course, that has to do with the depth, the magnitude of change. If we're way beneath the pivot line or way above the pivot line intraday for that transition, then yeah, it's going to make money. Sometimes it makes 100%, 25%, sometimes 500, sometimes 700%. But there is a potential to make some.
And your yep, internet doing both.
So the vector, when we start on Monday, you'll see I'll put the vector in there, and even if you're not trading QQQ and trading ES, it still gives, you can still watch it and see how to mark. And then a lot of times in the puts and calls, I'll mark lines, and those lines will become targets later on in the day. So if you see a line up there and we're red and we're starting to go green, I'll be watching that line to see if we can go up and touch. So they're artifacts. We leave the artifacts in the Qs and the puts and calls to achieve later on in the day.
Thank you, Russell. The next question is, upon wave 20 daily for QQQ, the longer we go without compression, does that mean the sharper / more intense the next MSI will be? For example, QQQ wave 20 daily, 1,000 days to load. We've been in the expansion cycle K since May 2nd, one of the longest expansion cycles above pivot for wave 28 in a while. Does that mean the longer we continue to expand, the sharper the next compression assignment and will be on the wave 20?
It can be. I've found there's no exact rules. Like when I look at, so I've got wave 20 up right now. And when we have been running a K for a long time. And I forget how the system, somehow it figures that out. Because you can see it left it as a K. It's not trying to whipsaw us all the time. So when this K popped out, this thing's annoying. It's set up to refresh. So yeah, when the K popped out. So a lot of times I've noticed just over the, this system I've been using over 30 something years. I built the core of this back in the 90s. And a lot of times I've noticed when we have an extended move up, if there's a move down short, it can be rather shallow. So that's something to keep in mind. Like sometimes the extensions above the pivot, the moves above the pivot, when it pulls back, they'll be more shallow. It's almost like the buy. So there's buyers going in and in and in. And then finally, they kind of run out of will, they run out of money, and they back off. And then the kind of selling kicks in a little bit. And a lot of the times that shallow pullback, people that missed the run up or they did participate in taking some money off the table, they'll rush back in. So sometimes on the fractal system, when you look left and you have these big ups, what happens next is a shallow pullback followed by another extension up. So we can have a K, then we could get a brief M followed by another K. So that's one thing to look for is like shallow pullback, maybe not have a severe pullback. I was last week looking for possibly a pullback because I thought it might challenge the vector and we might get underneath, which we didn't. We got back into the squeeze in the golden zone and then it took off again. So buyers kicked in. But I thought if there's a setup for a pullback, it might have been last week sometime, which didn't really manifest. It kept moving forward. But yeah, I would look just anecdotally, I would look for like a brief M, maybe followed by another K at some point, and not try to get too excited for the short side just yet. It seems like the best short sides are when we have a small extension above the pivot line, and you can go on the wave 20 daily and kind of look for yourself back to make sure I'm not lying, but or making stuff up. But it typically there's a small extension above pivot, and then that's where you can have a bigger pullback. It's a setup for a larger pullback. Again, when you have these big extensions, typically the pullbacks tend to be more shallow. They're short-lived, not super deep. They tend to be a buying opportunity. Bulls rush in again. So you kind of have to let these wave sequences die out. And the volatility, I'll tend to draw this. It's like a pyramid. The volatility at the base is, and I put this out yesterday. I turned the graph sideways, so maybe it could be a little easier to view. But the volatility ends up being kind of like a pyramid. At the base of the volatility tends to be the widest swings. And then as it's going up the pyramid, it tends to start to tighten up. And the extensions tend to become less, the pullbacks tend to become less. And then there'll be something that happens, and then the volatility widens out again. And right now, we're still in that base of the pyramid. And the other thing is, too, in the fractal system, this is something to also keep in mind. On top of the pivot, currently, we've had more, and the market is tuned long, so it makes sense. But above the pivot, we've had more of the price action, So more of the price is on the top of the pivot. And to validate that, what I do is when I pull up a fractal graph, I look at the right-hand price guidance thing where it shows, right now I have 621.20 at the top at 39%. So you can see the top, it's setting at 39 and the bottom at 24. So it's visually even showing you, hey, look, the long side is more potent than the short side because the long side has a bigger extension than the short side. The short side, smaller pullbacks. And you'll see it too on these imprints where it marks the out. You'll see that you get a lot of congestion between the -6% to pivot, and then you have less congestion from right beneath the 7% on heading towards the 20%. There's more imprints. So it's telling you that the market's surging forward more than it's tending to pull back. just by visually looking at that.
Thank you, Russell. Just to add on to that question, he just typed in, so if you wanted to short queue day over day, you would wait until we get the next M assignment on the wave 20 and do not try guessing when the next M will finally occur.
That's probably a bit safer. Like when I guess myself personally, what I found is I guess wrong. So if I'm like, I really for a M on the 20 daily, I mean, I would want to be closer to the vector. And so we do have reversion, excuse me, to the vector. You can see it visually back here on the left side. So we move away from the purple vector over time, and then eventually we come in contact with it and we get below it. So the market's testing that. That vector is a learning system, and it's learning where support and resistance is at. And it's telling us for the bulls to maintain control, they need to be at or near that vector. When they start to stray too far beneath that vector, the bulls are basically kind of throwing in the towel. Doesn't mean that everybody immediately flips to shorting the market, but the buy side just like lets off the gas, and it can wander around, or you can have shorts come in. But we always get reversion to the vector over time. The wave 20 daily is big, so it doesn't happen as often as like a wave 25 minute, which happens multiple times a day. But eventually, like this 612.64, eventually it will revise up, or the price action will come in contact with it. But I wouldn't get, super excited about shorting unless we can get beneath the pivot. It's like, yeah, you can try to scalp some shorts and stuff, but until we get to the pivot right now, the trend's our friend, and the trend is long. And until that changes, the worst trades I make, like during COVID, there was this one trade I made, and I forget the name of the company. I bought a bunch of options, and it was this company in retail, and it was beneath the pivot. Started buying some calls in it, and I was like, oh, tomorrow I know it's going to flip over the vector, it's going to get over the pivot, I'm going to make so much money, it's going to be pathetic. I feel sorry for everybody else. So I think it was like wave 7 daily. That's the sequence I was using for the waves up and down. And it was probably like, I'm guessing like about a 5L or something like that. So 5 consecutive days underneath the pivot. And then I started going into some calls. I'm like, going to flip. I just know it because they're going to do something with COVID and people are going to be back into the economy. And this retail provider, they did like retail cash registers, and then it's gonna kick back into high gear. My God, I think it went to like 30L or 60L, something like that. So my guessing, instead of waiting for the system, instead of waiting for it to be above pivot, so I have any type of a shot, I on a couple of occasions went into the call side, and I kept getting burned. And I know better. I've been trading since like 85, and I should have waited to be above the pivot because the thing's showing me it's short. The macro is red. The line below is rising, the standard deviation line. So it was way short all the way around. And just because I got in my stupid head that it was going to go long call side and I was going to beat everybody and make so much because the volatility was just knocked out of the calls, nobody was buying them. So I had bought them on a couple different dollar cost average in, which is another mistake when you're losing to dollar cost average in. If you're winning a dollar cost averaging in, that's a whole other story. But when you're losing a dollar cost averaging in, you're just going to lose more money. And that was like a big mistake. And I can't remember what that company is, the name of it was, but yeah, so it's all right to play, but I wouldn't commit any significant capital to the short side until it can show us that it wants to get underneath the pivot, where that cycle can be intact for a decent amount of time.
Thank you, Russell. Someone had asked actually if that company was named Toast Software.
I can't remember. It seems like it was ATS or something like that. It was in
Okay.
2000. Yeah, I can't remember the exact. I trades. Sometimes I have 20 something open positions and options in my account. And to me,
Yeah.
they're just all whatever. You just do a trade and then do the next one, and the only reason I knew that they were in retail, I didn't even know what this company was. It just showed up on the scanner that I was running in the Fractal system. And the only reason I knew what it was, I was getting so pissed off. I was like, what industry are these guys in? And then I was like, oh, retail. So that kind of, and then I was like, oh, it'll probably snap back, but it didn't. And there's kind of there was a study done years ago. They said in the market, it's about an 18-month cycle. So when the people in the US experience something, it's about 18 months for it to wear off, they said on average. So 9/11, kind of like 18 months until things get back to normal. COVID, about 18 months. And I knew that in my head. And that was a study I read years ago. So they said when you're trading, if there's a significant event, it can be about 18 months for it to unwrap into people's heads for things to get back kind of normal, roughly.
Thank you. We have two final questions for this section, I think. The first one is, does splice data care about the time left for the move? Let's say I'm looking at a Friday spliced. It's currently Thursday. If we are holding above the last Friday's close, can we still expect an $8 move to the next H or L value? Or is it not as valid because it technically had all week? Or is that still 60%, or excuse me, 67%? As likely, or would you want other confluences such as a closer time frame and squeezes?
Yeah. So, in QQQ Live, like if you've seen, like before I went on vacation a few days back, before vacation, I marked an arrow down to a price line, and it seemed impossible for that thing to be hit by 4 p.m. I mean, it looked like that arrow I drew was like something a child drew in there that made no sense whatsoever. It's like, how could Russell draw an arrow and the price be down there? I can't remember. It was like maybe 3 points above that arrow or 4 points. And we had like, I don't know, like 4 minutes left in the market. And I drew that arrow in probably 2 hours ahead of time, that arrow, saying that by the time we get to 4, we're going to resolve down there. And guess what happens? The last probably 2 to 3 minutes of the market, it just dropped right down to the arrow. So these stats, a lot of the times, or not a lot of times, sometimes for them to come to fruition, it can be at the very last minute. And what will happen is, and there's a reason for that. So as the trading day progresses, some people that are discretionary trading by hand, they might lose interest, or they might only trade part of the session. So as things kind of unwind, participants can lessen out. It's kind of like you're a spectator in a game, one side's winning, and then, the stadium starts to empty out because they're like, there's no way the other team could win. So it's kind of like that. Like at times participants will start to lighten up. And and the outcome of that, what will cause is volatility can be controlled. So all of a sudden, a few participants can knock a price up or down radically because everybody's left the building and now there's only a couple of big guys controlling it. And so when we get these stats, I mean, literally, it can be minutes to the close and things can adjust and the stats can come to fruition and they can play out. So, and there's like no way in the world that any analysis you can use it'll save you during that time. It's just a stat. So it's like maybe it shows 67% on Monday. We're below that certain price. And until 4 p.m., we can look back on it. Anything we do between now and then, we don't know if that stat will play out because it's just a statistic. So maybe the price will conform to it, and 2 minutes before close, the price hits the level we're anticipating. So it's like you can't give up. I don't know in QQQ, you know, the thing when you're watching, sometimes we have these high open lines. All of a sudden they're just hit out of the blue, it looks like. You're like, my God, how did it, you know, and then the option is at 40 cents 1 minute and $5 the next. In just a handful of hours, you're like, my God, how could it move in percent, you know? And just like the option I was showing, how could a low be at 6 and a high be at 3 something, 350? So, and you can see on that option I was showing earlier, a lot of that price action, almost all that price action happened on Monday, the 27th. During the week of the 20th, really didn't go anywhere. It just went down in value. And then Monday's where it made up. So let's say you bought it on Tuesday, you know, you're too excited, like, oh, I'm going to get into it. I just can't wait for Monday the 27th because I'm going to make so much money. So you get it on Tuesday, and then near Friday at close, you're like, oh, this thing's dead. It's not going anywhere, so I'm going to sell it. And then all of a sudden Monday comes around and, you know, it's at 350 and you bought like 10 or 50 or 100 of those contracts at $10 or whatever. You're like, wow, that was really a big mistake. Because, like, that Monday's the day that it made up all those points and hit that upper area. So it's really, when we're trading this stuff, we're trading a stat, a statistic. And then to try to bring in more confluences like oscillators and Elliott wave and whatever, order flow, it's like it doesn't fit. It's not fitting the model because the model's showing you what's been the outcome. So when you go into a trade like that, you're trading that percentage value. That's the trade, that 67%. If it works, great. If it doesn't, then you do it again. So that's what you're trading. It's hard to take other, and this is what I see too. I'll see people with like MACD and RSI and 50 other things on the screen, right? It doesn't, all that stuff doesn't matter. It's like, because when you're trading, if you're trading the splice and you're trading that value, you're trading that 67%. And it might be the last 2 minutes of the session. You know, it might be the last 2 hours of the session it hits. You can see on that example, it was right near the close where it peaked. Not near that 350. We were later in the day. So, you know, you're trading on that splicing Monday to Monday, you're trading that close price. And if you're a green candle, that close price is going to be near the high of the day. And that implies it's going to be later in the day, more like the 3 o'clock range. So that's what you're trading. And that's the big reward. It's like you go in at $10 and you can go out at 300 or 200 or whatever. And you know, you buy 10 of them and you feel like a god because you're like, oh my God, I can trade like nobody can on this planet, you know? So I would try to minimize trying to figure out all life's issues and possibilities and be like, I'm trading the 67%. I'm going in the vector, you know, at transition green. on the trade. Don't put too much money in it. So if it doesn't work, put McDonald's money in it, put $20 in it, get 3 contracts, 2 contracts, 1 contract, and let it play into Monday. Not trying to bring everything else into it and figure it out. So, yeah.
I think the last question, in line with your comment on dollar cost averaging on a losing trade versus a winning trade, we see this question a lot from newer traders. Can you please clarify what you mean by it's a bad idea? Tying in kind of with last night's session regarding risk management.
Yeah, so I have this Netflix up. So it's wave 25 minute. Let's say you're looking for the long side, and on October 31st at 12:15 we went beneath the pivot line. So like let's say you're looking along, you're like, "Oh, I know this thing's going to cycle above that pivot line for sure in the next 30 minutes just cuz like I feel like it is." Oh, we got an M assigned down below. We can see here if you're waiting for it to go above the pivot line, you're waiting and you're waiting, and maybe you go in at 12:15, you're like, I'll go long, and now you're sitting over here at 145, and you're like, man, it's still not above the pivot line, but I know it's going to get there. And it doesn't matter how you know it. Maybe you're looking at RSI or MACD, or you're looking at something else, right? You're not just going on this. And you're like, well, I'm going to add more money to the trade. I'm already down, but I'll add a little bit more money. So you're not rewarding the trade. The trade is not paying off. It's like you're doing a job and you're not being paid for doing the job. You're driving your car over and you're buying new clothes and stuff, and you're not getting rewarded or paid for that. And you sit there and then it goes down more. So, I'm going to buy more because I know it's going to go above the pivot line. And I know it's going to go bullish, go back long again. You're not rewarded again. So you keep taking stabs at it. You're guessing. You're like, I think it's going to go up, but it's not even here. So I look at this. One thing I look at is the purple vector. I'm like, is it even challenging the vector? Is it even trying? Because remember, the vector's resistance, and the vector is like a compression utility. It's pushing down on price, pushing down on price. So it's trying to keep the price short. It's trying to keep the price quelled, pushed down on. And if you look at so if you look at the system and just take it for what it is, when you're underneath the vector, you're like, okay, I'm short until proven otherwise. If we look back on the left and we're like, okay, it's, October 30th at 3:05, we're underneath the vector, and it stayed underneath there and it kept trickling down all the way through 4 o'clock. So so there's part of its hope. Like when you're underneath here, and you're M and you're looking at the K and you're green, part of it is reading price action. And if you're reading the price action and you're honest with yourself and you're like, well, it's underneath the vector, so it's short. So in my head, I've got to be like short. The only way that's going to change is if I hit an open line. How it had to come down here and hit the open line and it closed it. And that was the catalyst. That was the reversion. Because remember, the bears are trying to take it as low as they can get it. The bulls are trying to take it as high as they can get it. So if you're, looking at these setups and you're trying to dollar cost average in when, the stuff is showing factually that And we know the bears are trying to close these lines. When we look back on the left, we can see them trying to close. So if you're here and you just keep trying to dollar cost average your way out of it, you know, I guess you're thinking to yourself, well, if I buy enough, the whole market's going to follow me and start buying long. And the reality of it is, and this only comes with experience, is no, they're trying to close this open line. You know, when I'm doing QQQ live, like I'll be like, okay, we've closed a line, and then I'll put a comment in there, reversion. That means when we close a line, are we going to have reversion? So if you're looking at a counter trend trade, that's the spot to do it. It's not in the middle, because in the middle, all your dollar cost averaging, you know, you're just wasting time and money. So if you buy long here and you don't have a stop and you're actively trading, you know, you're just going to get beat up until you come down and close this open line. And if you look back left, you can see factually they are opening and closing. So person yesterday was talking about how I had to get real regimented, right? And you know, look for certain things. And here we can see factually on the left that our best reversion, our best counter trends come in when we're typically closing lines. Because again, the bears are trying to go down to those lines, the bulls are trying to go up to those lines. And the bulls and the bears, when you go down to the line and you close it, that's the catalyst, that's the trigger for the reversion. And because it's funny, like in the QQQ Live, we'll see when we close a line, all of a sudden the market reverses and we go up, or we close an open line on the long side and all of a sudden we hit it and close it and we go back and we go down. And because people at the institutions, they're doing what we're doing and they're creating their, you know, their resistance and support points. So they're creating these nodes. It's basically a data node, a data point. And when they achieve it, then they look for the opposite. You know, so when you know, you just don't want to keep dollar costing trying to right a wrong. You know, and it's the example I was giving. I was dollar costing when the system was showing me short. And it's just like stupidity of me. And I make mistakes all the time and I try to minimize them. So, and that's one of the biggest mistakes. If you have, let's say you commit 500 to a trade, put the 500 in or split it into 2 pieces or 3 pieces, you know, so you do one and then another and then another, as long as you have a game plan. But the dollar cost averaging usually is without a game plan. It tends to be like, well, I'm not winning, but if I put more money in, I'm surely going to win then. And if I keep adding money, I'm surely going to win because it's going to reverse. You don't know that. I mean, this thing Netflix could have kept dropping to 1,000, you know, so it's best to have one of the plans is, so I use open states a lot because I dig them. I can see them easily. I can watch the vector tracking price. I can see price kind of heading towards them. So I like to put in my trading graph and you know, I like to see the price, even if it's meandering and getting up in there. I like that. I like seeing that. And I like to see where I can, you know, red to green transitions, where I can go in and have a fair shot at winning. So, yeah, man, dollar cost averaging, just unless you're set up to do that, you have a plan for it. And, you know, maybe you're like, oh, at this average green line, I'll buy in, hope and pray, even though we're not to an open line, even though I look left and I see that they're being hit and we're having reversions off of them. You know, you just got to try to control yourself and not do it, basically.
Thank you, Russell. I think we had one final question, and then we'll let you rest your voice. I know you've been talking for a while, and Thank you very much for your information. This is the last question. If this is too off topic, please disregard, but I was curious if you could touch on the mechanics of the Russell TTM Pro squeeze indicator and how to best interpret what it's saying.
Oh, I know John Carter did that thing, and he did the Keltner channels and standard deviation, which is fine. But his stuff, like, I like personally, um, so when I first started doing squeeze stuff, compression back in the 90s, I started doing it like this because I like to see the proximity to the squeeze line. And, he basically just puts in dots, so you can't really see the proximity. Because if I know we're dropping into the squeeze line, I know we can have an expected expansion out. And, with the dots he does and stuff, which there's nothing wrong with the way he does it or anything. It's just, for me, it's just like, but then I can sit here and create all kinds of different software, right? And if you don't have that ability, then, you're kind of relying on what he's done. They have, for I think $200, you can go over there. They have all day long sessions they do. They don't really, it's funny though, they don't really interpret. I've posted over there and stuff a lot over the years, but they don't really interpret those signals usually when they're in their chats, which is kind of weird. But yeah, I don't know. He's trying to do the Mac, so they do the MACD and then they do the squeeze dots, and it's supposed to indicate when the price is constrained here. So here we do standard deviation because a form of it framed up, because I can see it visually and I can see that it works. So for me, it's just, I like to see it this way. Yeah, I don't really have any suggestions on watching the dots and stuff. I don't know. On that TTM Pro they have.
All right, perfect. Thank you. So we're now going to kind of transition into the mechanics related stuff that I've kind of been showing in the chat recently with exposure, delta, all these different things, kind of fully explaining that, what it is, so you guys can learn how to interpret the data. But I guess while I'm doing that, are there any questions, comments, anything at all related to what I've just said? Feel free to speak up, by the way, and just, you can pipe in the chat or whatever.
Yeah, I think that stuff you're showing, Big Gun, it's can't be underestimated, the power of it. You know what I mean?
I appreciate a
Very
lot, Russell.
potent stuff.
Thank
Yeah,
you.
because
Yeah,
we're resolving. We're that GEX stuff. It's been out there and known, and we're resolving it in a very unique way, and which gives us a really good insight into how the market makers are positioning, because we can see our ceiling and floor, we can see our PML. So, and then that allows us to create derivative data like you're doing, which is particularly awesome.
Absolutely. And really, we're kind of, think about this. People always talk about GEX and like, oh, it's, godsend of analysis, but it's not simple enough to where you could actually like do reliable I mean, it really would take a lot of effort to boil it down into reliable signal processing information. This is now a new frontier of like market maker analysis that actually it can be done for futures, it can be done for options, either one actually based on this stuff. And it's really simple thing like we're kind of showing it in QQQ live with the zero delta lines and all these things. But that idea can be kind of coalesce into like an actual signal that can be ran, either inside the actual data warehouse, like you could run a query that basically acts as a signal finder. Secondarily, you could, an external program could, receive, manage, export the signals kind of like into the infrastructure you talk about, Russell. And so this is really like a new frontier that I hope people kind of take the initiative to master this as quick as they can, because like we always are, looking for like it's new perspectives. Like really anybody, like I'm just a normal guy. Like anybody can kind of figure out new stuff inside the database. And I would say kind of like, as in terms of like where time is spent by the user base, right? It's really not inside the data warehouse at all. Like a very, very minimal percent. And I want to encourage people to kind of like, be able to like when I'm gonna put out, hopefully will serve as a foundation for people to build their own stuff, right? You could once you have the math done for you, it's pretty simple to just add like some filters to the data. So I hope that everybody's kind of getting the picture of like as kind of Russell puts it, like not to underestimate the power of this. This is almost a novel form of like maybe fractalizing price data in a very simple way, right? So take advantage of this. Ask questions as you have them, right? Questions are best asked while we're in the voice chat, right? So even if you think it's like a bad question, or if it's something that's like very basic to the MMs, like what is a PML, like those kinds of, I mean, those are kinds of questions are welcome. So I don't want to have anybody think like they can't ask a question, right? Always ask. Um, Lem says, are there any thoughts we can take to see if a repeated exposure at the PML from day to day? So basically, what we see in this, I kind of forgot to explain this, that cycle of the mark price exposure, what happens from 9:30 to, I mean, it depends on a variety of factors, but somewhere between 10:30 and 1:30, generally I see this resolve about 10 to 11:30ish from what I've been seeing, like very, very roughly, right? That is where the spot price exposure, it kind of reaches a predictable, potentially maximum, right? And so from basically, if we can think of like this, this, let me get on MS Paint. Hold on a second. Uh, while I'm doing this, mark price exposure is essentially like a parabolic function, right? You can think of it kind of in this way, right? And so let me show. Hold up. Okay. All right, let me start from scratch here. Basically, this is mark price exposure. X-axis is time, y-axis exposure, right? This is kind of what exposure looks like, and it can look like a variety of different things, right? But there's basically 2 points of interest, right? Where are we expanding and where are we decreasing? You're going to look intraday and it's going to be spiky, right? It's not going to necessarily be a uniform, perfect slope, but you'll see a general trend, right? And so basically, this point, you could think of it. I think of the word like apogee, right? Like I forget. Like there's a word that I'm like forgetting for this, like the crest of the parabola, right? This point is where essentially the charm effect, time decay effect, or kind of charm is like a broad, like both IV and time decay effect start to set in. And that basically there's two, like market makers are hedging in two ways. Like either A, right, when you have like you can think of it as like initiative buying or selling, it doesn't matter, just it's arbitrary initiative hedging, where they obviously initiate a hedging protocol for a new option, and the delta, absolute delta of like Black-Scholes delta, right, going back to like as a generalized idea, sensitivity of the option to the underlying delta, um, is trending up, going closer towards one, right? You could think of that as initiative buying because they can theoretically buy like kind of up to 100 shares, right? In terms like that's what they can buy up to, right? Subsequently, though, we can think of the charm effect where basically delta is reducing for a lot of these options. They have to close these hedges, and so you could think of it as like kind of the oh my god, I can't speak, opposite of initiative hedging, meaning they're basically closing deltas, right? And so the mark price exposure can actually kind of give us a hint of like when, as a general idea, like this process is beginning to foment, right? And so, like, right, so we see the parabola, right? And so let's just say, like, we'll say this is kind of around our average time 11. From this point, basically, there's a couple things happening, right? The IV and time decay of options is beginning to set in, quote unquote, accelerate, right? As we get closer and closer to the expiry. And so this is what we're seeing, right, day over day, how this happens, right? And so you'll look in that mark price exposure and you'll see kind of a variety of, there's basically, this is like a good day for market makers, right? When we get back, when the parabola ends as close to zero as possible, right, in time. But there's a couple scenarios where that's not always necessarily what happens, right? Sometimes we get basically this. Hold up. Let me redraw this. Hold up. Gosh, I'm super bad at this. Hold on. I need those Russell MS Paint skills. Okay. Basically, exposure oftentimes will like look like this, and what we call like a basically a positive exposure is really going to actually look like this. Hold on. Right? Where this is the zero line, and positive exposure rapidly, of course, increases above that. But I want you to start thinking of it in terms of like an absolute exposure, right? Because that's really what's kind of like, I mean, relevant in my like when we go into positive exposure, it's gonna be deep in there most of the time. Like you'll see from the spikes if you kind of look at that 100-day graph, look at where the positive exposure is occurring and compare that to the length of the maximum negative exposure, and you'll see obviously like a noticeable difference, right? And so that exposure I was kind of absolute exposure, right, would look, I guess it's going to be positive, but we'll just I like to have it kind of think of right going down as positive right on your axis, like I guess. So hopefully this isn't confusing people. Basically, a lot of the time it'll look like one of two things, right? Either A, where it's like this into the close, right? This is kind of exposure where it's like obviously, bulging, but it can just exponentially bulges as we, move away below the floor, above the ceiling, whatever, right? It can also look something like this, which this is kind of how it looks a lot in these ceiling collapse regimes or something where we have a very weak floor, where it basically kind of looks like this, and we end here, right? The zero line is all the way up here for these market makers. We're closing right, in an unfavorable position, right? And that's not, this is I'm not this is a very uncommon kind of thing. This is just showing like potentials, what can happen, right? From the mark price exposure, you see like as a general rule, where is it resolving? Right, the right end of the parabola, it's close to the zero line, right? Generally. Almost always, right? And that's kind of, I had posted that, and someone's like, "Well, isn't that like implied by Vega mechanics?" I'm like, "Well, yes, it's implied, but now you're actually seeing the math rather than just thinking in your head like, oh, like, as X theta goes to zero, in the money delta goes to 100, absolutely, and out of the money goes to zero. Like that's like kind of like what that person is saying to me. I'm like saying now we can actually see the math and perform these, signal processing capability. We can basically, how like for example, user has her end of day close thing where we can predict like if we've reached a maximum right in this point at this time of day or relative period of time, right, from 10 to 10:30, what is the implication for volatility to follow, right? We can start to actually perform like a lot of basically complex conditional. If you've ever heard of like a Markov chain, right, that's kind of moving into like a very simplified version of that. We could perform like conditional, statistics and basically imply behavior for the rest of a session, right? Let me look up and see if there's any questions. I'm like rambling a lot. Um, can you show how to read odds graph implied volatility to what's yeah? I think Russell's doing that right in the chat, but we'll go over that.
Yeah,
Um,
yeah. I've been showing it a little bit again as you've been talking because I mean that
Perfect.
whole thing. There's a lot of information in there. Yeah, you can show it. Maybe he'll understand.
Yeah,
With the
I'll go on
googly
that.
eyes, I think it's a
Yeah,
little more apparent
yeah,
now.
yeah. Let's see. Really, like, gosh, the odds graph is honestly one of my favorite tools in the system. Like, kind of like for my own private trading, it's something I like out of the spread monster. Like, I would say, like, I almost there was a point where I would like for futures related stuff, I'd be using this more than the IV, right? And so let's go into our typical wave one daily spread monster 200 days to load, since we're at a 1H, which is favorable for us to just do 200 days. And we'll look at our odds graph, right? This is what Russell is showing for next session, kind of just blowing it up a little bit, going over really. So, okay, this is what Black-Scholes BS, quote unquote, tells you. God, hold on, I need to take a picture of this and like get it into, I need to get it into, I'm not even sharing my screen in. Let me get this into Paint and then I'll start talking. Hold on. Okay. Just give me a second. Okay. Basically, hold up one second. All right, perfect. All right. This is the distribution of historical volatility. Okay. What, MIT and all these guys thought for many years, and they still will, like what people like kind of think like are taught about from GEC specifically in that is that price follows a quote unquote Gaussian distribution, right? You can remember that. You can also think of it as a normal distribution. Right. And so a normal distribution is sort of, this is like a bad example of it, kind of like, actually, let me hold up. I know where to pull one from the system. Just give me a moment. Hold on.
I just posted in Big Gun. I don't know if it'll help you.
Perfect. Yep. No, that's super
Distribution
helpful.
against turn
Perfect.
sideways graph.
Yep, exactly. Perfect. Thank you so much. Okay, and so basically that's what Black-Scholes guys will tell you, and that they're wrong. You can obviously see we're showing the historical distribution of volatility here. Does that look like a normal distribution? No, it doesn't. Right? Um, it can kind of be characterized into two ways. Right? This is called a Galton distribution. Right? But as a broader function, like what is this like how can we relate this to a broader function? You can think of it as a power law distribution, and you can look that up. It's a little bit like complex for me to get into, other than the fact that what it means is that basically there are quote unquote fat tails to price action, meaning that the incidence of days where we are moving, -5%, all these whatever, occurs hundreds to hundreds of billions times more often in price action historically than it should, right? Compared to the normal distribution, right? As a normal distribution, the further you're getting away, right, from the center of your graph, essentially your function is like a constant exponential function, meaning like it's like getting asymptotically closer to zero, but never zero, meaning that like, what this models is the idea of a 7.2% idea is not one, doesn't occur 1% of the time. It occurs 0.00001% of the time. As an example, right? We see on these graphs, you'll always see that these tails basically will be like somewhere, 0.5% to 5%, 10%, right? That is the nature of a power law distribution, fat tails. That's accounted for. And you can look that up. I'm just telling you like what the math is. Look that up on your own time, because this is what is more relevant, obviously, the Galton distribution. Right. Basically, what we see is that the distribution of historical price action, when we kind of are filtering it into like only H1s or only L1s, is quote unquote irregular, even relative to a power law distribution, which is quote unquote smooth in a way. Like this is an irregular distribution, meaning like, right, y-axis is basically the occurrence of a high or low at a specific level, right? The x-axis is price. Okay. Basically, we see on the long side, for example, like this distribution here, like in this, let me circle this. Let me make sure, okay, you guys can see this. Basically this, right? These kinds of little irregularities in the distribution are quote unquote points of interest, right? This is like this, and this is getting into like what is the like meaning of like the like how do we use these lines and shit, or sorry, excuse me, stuff. Like we are looking for these irregularities in the distribution because these provide supportive or resistive structures, right? And so Russell's kind of showing a lot, as well as like kind of the odds graph, win rate, all these, basically the long and short theoreticals, which we can kind of basically say what is the win rate of this, hold up, this level, right? Like holding strong as a support, we can define this quantitatively as a win rate because we have a sample of data, right? And we're modeling this distribution, right? Um, let's see if I'm missing any questions. Okay. What are your suggestions for wave time? Okay, pulling the odds graphs. Okay. Mainly, here's what I do. Okay. I'm gonna actually do this from scratch because this is like a big question I always get asked, and it's like it's kind of hard to see unless you're actually like watching someone do it. It doesn't really make a lot of sense just verbally. So we'll go into this. This is actually a perfect. Let me restream my screen. Hold on. Perfect example of and what we want to look. What is the baseline resolution? That's actually what's the number one most important question? Baseline of resolution of our data. Right. And so the way we can kind of get this is looking at our H1 or L1, right? How many occurrences over the span of 200 days? Like, what is the quote unquote max count? Right. And so we see for our H1, it is 102. And so what you'll see is like, regardless of our volatility, for example, during April, this was closer to like the max count was closer to 70, right? Which means that we're more volatile. We have more persistence of price over time, right? So this is kind of like showing us like what is the baseline resolution that we need for our HL side. Weekday matching, right, is looking at the last 200 Mondays or whatever. So it's not like the amount of like actual H weekdays in last 200 Mondays is not changing. That's a constant number, right? But in the last 200 days, we can see that there's a variable number of, H1s, H2s, H3s, all whatever, right? It's arbitrary. What you'll see is there's a kind of like a distribution, right, that Russell shows is that obviously, there's 100% occurrence that eventually an H1 or L1 is made, right? And from there, we have a distribution of like how often do we persist to an H2 or an H3 or L2, whatever, right? And so what that means, right, in terms of the odds graph is that in order to maintain the same sample size of data, right, as if we were looking at the baseline resolution of data, which I say, in my opinion, is the max count, right? You see 102 on the screen. It needs to be a minimum of 70, ideally below 100 or at 100. I mean, it can be 100 too, like it's not changing by 2%. It's minimal, so it doesn't really matter. But that's kind of like the base. Write that down. And if anything to write down, that's it, right? How do we make a 5H get a one count of 100, right? It's very simple. What we do is we exit out and we go to our days to load and we increase this number until we optimize it for that. And so I know we had a 5H a couple days ago. I'm gonna just play around. I mean, I wasn't looking at this in the day, so I don't really know like what you had to do. We'll just say we're gonna look at the 5H, right? And so one thing you'll notice, right, when we talk about resolution, there's such a thing as called over resolution, meaning that that sample of data that you have has too much information. And what that causes, actually, you'll see in my screen, is it causes that distribution to smooth into the power law distribution that we know and love, right? And so when you are obviously you'll see like there's still irregularities that are there, right? But they become less and less and less and less monumental, right? Less important, right? So no, hopefully that makes sense. So I'm going to click on my 5H. Oh gosh, I hope this works. 5H is my origin date. I might not. This might not be working for me, but basically, if we looked at this, gosh, hold up. Yeah, I don't know why it's giving me trouble on this, but basically, if we looked at this, hold on, let me see if this one works. No, it's not gonna work. Basically, if we looked at this, the count would be somewhere it might be over 100, I don't know, but you increase the amount of days to load to get to that number. Hopefully that makes sense. Sorry, I can't display it in real time. Actually, you know what? Maybe we'll look for like a magnificent stock or something like that. Like I don't know if anyone has any like ideas of like what is like super overextended one way or another. Just like to show like optimization, like what that means in real life. Um, I think I'll do like I'll start with Apple or Nvidia. Um, what this is also relevant for is IV walls. You actually need this kind of resolution function to get proper IV walls, right? Basically, right, the points at where, like the endpoints of the Ivy wall spaghetti curve, I forget the name for that kind of a function, but the endpoints of that, right, are always going to remain like static, like regardless of the amount of days to load you have, those will always remain in the same place. But the way that those functions get stretched is relative to the historical volatility sample that you're looking at. And so when we are at these 5Hs or 5Ls or whatever, you actually need to increase that resolution to be in order to have like the same perspective as if you were at like an H1 L1. Right. And so let me pull up NVIDIA. Let's just see if this works. I don't know if anyone, I mean, honestly, gosh, I should have just written a query for it. It's pretty, if you do signals general, you can get the HL values for these things. I'm just kind of time strapped, I guess. It would probably take me longer to write that than just to look. We'll see if this works, but hopefully you guys get the picture, I guess. If there's any questions on that, if like, ask them now. If there's not, I'll actually just move on to other stuff that we can talk about. I don't want to spend all day on this. Okay. Seen anything? Kind of the questions look to be directed at Russell in the chat, which obviously great to be using if you have anything, don't want to speak up. So we'll go kind of, I think we've covered the most of the stuff I had for MM mechanics. So really, I think now some people were asking about like live analysis and things of that nature. We can kind of briefly cover that, and I'll let kind of Russell also, speak up for that. I think a big thing is gold, right? And so back several months ago, we did a UAT session on basically, implied volatility indices, right? Gold actually has one that's relevant here. It's the GLD implied volatility, which is a gold ETF that basically like maintains a holding of gold futures, right, to replicate the spot price of gold. And so we'll go to GVZ and we'll check that out first, right? Immediately here, I see something pretty critical. It seems like we've topped out in these long cycles on the IV, at least for this short moment. We're in an L cycle. As of Friday, right, this is big. Look at our macro trend. We are red. Again, what does this mean for gold volatility? It's descending over time. It's in a down. Oh, of course, I'm not showing my screen. Hold on. Okay. GVZ, gold volatility index. Right, this is the peak of implied volatility. Even after this downslope and a little upslope, we are now in a red macro trend. We will persist in a red macro trend below the 24 level on GVZ. So you can kind of mark that, I guess. Like this is as relevant as the VIX is to SPX, right? So use it. Um, we can see a potential slate of lows that we tend to target here, especially like after these spikes. You'll notice a couple like basically we get one up cycle, two down strokes, one up cycle, potentially repeating the same thing, traversing from 22 to 18, which would be roughly like a third, not even like a between a third and fourth like decrease in volatility or whatever, right? In the implied volatility. So what does this mean? Is that GLD options premium, day over day over day, is deflating. What this also means for gold futures is that likely that kind of volatility is like basically the future realized volatility is also deflating. Um, as a reference. That's kind of what I'm seeing from this initially, right? What do we? what's our reference of okay, what's our relevant point for determining like, oh, when is there a breakout in gold volatility? And so even though for the VIX primarily, like, VIX up, people think VIX up, S&P down, which is not, that's a complete falsehood, number one. But that's like, you could think of it like is there a statistical correlation to that? Like, yes, like about, I think it's roughly 70% of the time that's a correlation exists, right, in the market. These commodities, like things like, there's a silver volatility index, gold, it's not, the correlation is not the same. So you need to get that out of your head first, because the implied volatility, as you'll see during this gold thing, like I mean, obviously, like there's a weight to like say like there's a 10% downside move cause the GVZ to move up more than a 10% upside move in the same period of time. Like, yes, right. But nonetheless, like either side is relevant. And so what we can use this for is to kind of visualize like a quote unquote short squeeze, as well as like kind of the opposite effect where basically now there's a couple things that like, all the premium is evaporating out of the GLD chain. Ultimately, like kind of the GLD ETF issuer or whatever who is buying and selling a large position of gold futures, that is sort of coming off, right, decreasing in absolute size. So what this means for gold, hopefully, I guess for some people, they hope kind of volatility starts to calm down a little bit on gold. We can see kind of past, a good example actually. This is gold obviously rising significantly during the April tariff follies, right? And then kind of after this point, there was a period of lull or calm for gold volatility that you just look at the price action chart. It literally just gold goes up, it flattens out for like several weeks, a month, or whatever, goes back up again in this same period as like kind of we are reducing these downside sequences, increasing the upside. That's kind of the period that gold is waking up, right? In terms of price, it doesn't matter up or down, volatility as a general. Um, so that's GVZ. We'll go into the gold future. Actually, we'll check GLD and then we'll go to gold futures. So we've recently got GLD into the database, Periscope, IV. All those things have GLD now, right? Expect also these option ledges, right? So start using those. Immediately, something that sticks out to me, like very, very obviously, is that there's a high amount of in the money put exposure, right? You can see all the way up here and here, which this typically suppresses price, kind of like just on any, it doesn't matter, any ETF or whatever, like that positioning basically causes two things. Market makers have a massive like initiative position. They need to short the GLD stock. The GLD issuer needs to short gold futures or sell gold futures. And that basically, the farther we move away from these strikes, they're kind of adding up to 100 delta, right, onto those positions, right? And if those remain in the money, it basically causes this effect where we're kind of trapped bearish in a way for whatever the period of like interest is, right? Like until this options interest expires, right? We're going to have this persist. If those remain in the money until expiry, right, the only time those hedges are being closed are when the options are delivered, right? Um, or for the most part, I guess, right? What we can also see if we look to the downside, there's actually like a pretty significant amount of kind of out of the money speculative put exposure. We have our average strike put. What does this imply to me is that we potentially have like kind of more downside in gold brewing here, meaning that like there's a lot of basically potential if we can break kind of like very minimally below like last week's lows and stuff like that. We can kind of continue to push the envelope on that and just continue like this wave cycle. What we'll see developing here, right, is especially like we see this pattern. This is a very, very common commodity pattern that I see all the time, especially on oil, really is where I see it, but gold, you can see it developing here. Basically, these kind of compression patterns, right? These like, right, this is the period of highest volatility, and then both sides it kind of pinches, right? And I forget what does Russell call this. He calls this what's the word used for the pastry squeeze? I think, right? Am I right on that, Russell? Hopefully.
Yeah, pastry squeeze is
Yeah.
what the guys in the industry will call it sometimes.
Yeah, so we can see the kind of pastry squeeze that's going on the gold price. Also think back relative to the GPZ, right? How is this pastry squeeze being defined, right? We can see this kind of defined in the price action. And so we're now coming to a point where we're trying to determine a maximum in realized volatility and then undergo a pastry squeeze again, right? It's still ongoing, right? It's not necessarily like it's can go either way. One thing I'm also seeing on gold, right? We have our in the money significant put exposure, but really we have a pivot of interest. Kind of like, we have this massive like at the money call exposure at the 369, 370 area, right? That's a massive, call exposure there that if we traverse above that, market makers are going to start being required to buy stock. Right. Ultimately, what we see here is the OI pivot and options midpoint, right? Kind of overlapped here. This is like kind of you could think of it as like a function of like what is zero delta. It's like a very like broad idea of that. And so we could see like above this, market makers are passively buying stock. It'll grind here until we kind of get to this 382 area. If this was basically demonetized, market makers are required to buy back substantial amounts of GLD. GLD issuers are required to increase their gold positions to maintain NAV, right? And so what this causes, right, is ultimately the gold future would rise and like kind of we can see all these like the roadmap of like all these different levels of interest, right? Um, where could it potentially rise to, right? We have our call bulge in this area, right? And it looks to see if this call bulge is broken right here. These, this 402, 399 open is in range. But ultimately, it kind of looks like to me, maybe Russell, you see something different. That in terms of like, the bowl, like we've are kind of like at the sort of like crest of the bulge in terms of like you think of like an envelope that's containing this price action. We've kind of created that crest. Maybe you see something different, but you can see this developing, and so we're in process of the pastry squeeze once again. We'll check out the GC gold continuous futures. Look, it's going to look pretty similar. And if any, like this is a 500 day. And so we can really see like the pastry squeeze cycle kind of very clearly here. It looks that we're kind of determining a point of this amplitude, like being at the highest point. Just kind of looking back at our historical price action, I'm not really seeing much in terms of like the continuation of this in the immediate term. But what this really does ultimately is it kind of like creates a lull in the price action. We will flatten out for a little bit. We'll develop a range. Kind of, if you go look back at what happened after April, the gold meltdown after this lull of volatility. No, it kind of consolidated. You could for like a very like blanket term to call it. What this provides is kind of room for eventually another, basically the opposite of a pastry's expansion, right? Someone's filling the pastry, I don't know, kind of expanding, right? That would basically be another like leg up in the gold cycle. Ultimately, kind of as a general idea, it's pretty clear, like from kind of our Treasury's fiscal policy, especially in the last 10 weeks, roughly, us selling record after record after record amount of short-term bills that kind of like, the nation is basically the U.S. government is willing to continue inflating, if not accelerating, the rate of national debt increase, right? And so ultimately, what does that do but debase the dollar, right? And so there's obviously like a quote unquote premium to gold that exists, but ultimately, like there is like gold is not trending lower. The debasement cycle for the U.S. dollar has begun, right? As we showed from DXF, our US dollar futures, which are it's kind of like weighted in a basket of other currencies, right? Um, that the rate of US dollar debasement has potentially reached a potential exhaustion point in the immediate term, but ultimately, right, like especially when we're starting to get maturity on these clips of like $80 billion clips a piece of like 6 week, 12 week, 1-year bills, like when that starts to kind of roll in is like when you would potentially expect another shock because the US is going to be required to like issue another increasingly large set of short-term duration to kind of pay for that. That's what when we talked about earlier in the this year, kind of like where were these points of like pain for the US Treasury to refinance, right? We had July as a big hump, but now also, right, a big hump, especially with obviously the government shutdown, right? And so this is you can just kind of look at the math yourself, like look up like the issuance rate of short-term duration. It's on a very clear trend of increasing, and I do think like under Besson and Trump, like that is like I don't think we would expect that to go down. It's almost the Yellen strategy on steroids in a way. Well, Yellen had the option to obviously, issue like a lot of long-term, like relatively cheap debt. Like now, there's really no choice for the U.S. but to kind of like continue hammering down that short end of the curve. So, um, that's kind of like I guess general dollar debasement theories. So what does that also mean for equities, right? So what does it mean? It means nominal highs in equities. It doesn't mean actual like in terms of value. You can look at the S&P versus gold as an example of the last 6 years. And so what I mean is like the S&P in dollar denominated terms, yes, can be making highs, but in terms of actual value existing, it can be questioned as to whether like there's new value being created other than like, QE and the debasement of the dollar encouraging, right? And so that's I'm look, don't I'm not a professional. Like this is just like, like me like trying my best to like make sense of stuff. I'm like a 20-year-old guy. I'm not a professional by any means. So, you can challenge me or say whatever if anyone, has like something wrong with what I'm saying. This is just a generalized overview of where we're heading. What does this mean for gold? Obviously, is continues to like perpetually like have this perpetual rise in a way. That's not to say that we don't have corrections and periods where we'll contract severely. That's actually what kind of caused those contractions are kind of a function of this general debasement that's kind of ambiently going on. And so Jim Simons actually has a good interview people can watch about him and his partner, like kind of talk about their trades on gold futures back in a meteoric rise back in I think the 80s or the 90s or something like maybe the 70s. I don't know if it was late 70s, one of the two, where basically gold markets were shocked into go skyrocketing. So they talk about a famous day where basically Jim Simons is kind of like out of his gold position. He's telling his partner like you need to sell this, and he's really getting adamant on him like you need to sell this. And basically the partner is like, okay, I'm selling this, right? And the next day gold, gaps up like it's like up another, $50, which in that like that's like, up another 3%, right? But then by the end of that trading session, gold is down 20%, right? And so obviously the guy's like, very thankful to Jim for like, keeping his head on straight, right? But what does this kind of tell us about gold and, commodities in general, but we'll focus on gold, is that their volatility is a lot more wildly variable um, comparatively to equities. And so this is just something to consider. Like if you're someone who's like looking for a way to position like a portfolio like long term, right? That is like, deep in gold, you need to be very, selective in terms of like where you're positioning because of these contractions that happen. Like we'll look back and we'll say, oh, gold, is at maybe $6,000 an ounce in 5 years. Like who know? Like I'm just throwing out a guess, right? And we'll look back and say, oh, gold went up. But like along the way, like there's obviously a lot of pain for some people who are holding long gold or whatever because of these contractions. And also, a big thing to note is that ETFs, GLD, and such, like they maintain a quote unquote NAV, like native asset value, I think, or something like that. Basically, like a premium or discount or parity with the underlying thing they're trying to track. And these kinds of contractions can actually, like historically, especially really in the volatility sector, is kind of where this has happened. Those kinds of contractions can be lethal for certain leveraged, funds and stuff like of that nature. You can look back at there's been a myriad of vol related funds that are leveraged that blow up on these kinds of contractions. I couldn't necessarily say the same for gold. I don't know if it's as popular those kinds of leverage funds. So, but I'm just saying, like, I'm not saying GLD is going to blow up. I'm just saying, remember that ETFs are not one to one with the underlying gold spot or gold future. Like, and this is true of any ETF actually, but especially for these commodities, right? They have a much higher variance and such. You need to kind of keep that in consideration. Like, you can look at GLD in their website. One of the times that GLD has a premium to the gold futures and discount, right? Essentially, if it's possible to be sniping, GLD leaps or stock or whatever, right? You want to make sure that you're buying it in discounted conditions. Um, the times that we're basically GLD trades at a premium are in these kind of like, squeeze upwards. And so it'll have a premium. And if you're buying in those locations, aside from like the native spot price of gold going down 20%, you're also tacking on an extra like, potentially 10 to 20% of native asset decay that's going on there. I'm not saying GLD, but a leverage product maybe. So that's kind of something you also need to consider, because a lot of people, if you bought back in February when I gave out my initial like kind of gold monster rally thesis, like it would almost be impossible for you to be down in almost any sort of long gold position, even if like even miners have like marginally increased since then. But obviously now is a different environment, and we're in a stage where like the variance of gold as a long-term perspective is on the uptrend. Look, so this is you can kind of look back. Like, I don't know if you can look back in the fractals all the way to like 1974, which is when gold became legal to trade. Um, so obviously that's when the futures contracts are created. But you'll look back at that period, kind of like at post Nixon shock. There's a period of like kind of late 70s, early 80s, like this gold period of interest. Kind of like the variance is massively changing, right? And obviously, since gold was fixed to the dollar price pre 1970, like you are not going to be able to measure variance of gold in that way. But post 1974, you can kind of measure that. I think we're in a similar era of dollar debasement, right? And such, like kind of subject to that increase in variance that comes with it. Um, Ultimately, the only thing really like is like regardless of like what your choice is, gold, silver, all these things, like the one thing you definitely do not want to be holding is dollars. Almost like I don't know how that couldn't be any more clear, especially after like the fiscal policy, like the treasury policy of the last several weeks. It's very clear that like the dollar is on a cycle of debasement, and so it's not something you don't want to be sitting on the sidelines one way or another, right? You don't want to just be holding on to cash. I've been talking a while. Are there any questions, comments, concerns, things of that nature to what I've been talking about with this analysis? And then kind of from there, Russell, if you want to chime in on your perspective of gold and anything else people want to see.
Big, and I do actually have a question. Could you do a checkup on the silver play that you were announcing? If we're
Sure. Yeah.
how well we're doing for that?
Yeah, let's check on that. So silver is also a good example of like let's check the silver volatility index first because that'll tell us whether we're potentially moving to a pastry squeeze. Um, Hold on one second. I need to like really fix my list. I can like barely read. Okay. I think it's this VXL. Yeah, this should be it. Okay. So this is the silver volatility index. I think there might be an issue. Let me try the daily. Yeah, the daily isn't working because Yahoo, but this is where silver is, right? And so immediately what we're looking at when we look to the left-hand side is, are we at a potential point of a low in the volatility premium of silver, right? Basically the implied volatility of the SLV ETF, right? Kind of subsequently like a potential low in the variance, right? I would say we are, especially like as long as we can maintain above this 33 area, like there's a low being carved out one way or another. And so what does this mean though, in terms of the price of silver? Let's look at SLV on the, wave 760 minute. We'll take a look. Hold on. All right, so this is hopefully this is a similar period. Or hold up, let me make sure this is the right time frame that we're looking at. Okay. Okay, so this is silver over that period. And so what do we really see, right, is that on these basically major, like, what is the correlation, right? Is it 50-50 bullish bearish in terms of like that volatility? It's really like more so we can just see the bulge of volatility that is resulting kind of from this point here to here, right? Look at our standard deviation. This is what we're really seeing with VXLV. And so what does this mean is that silver volatility is potentially rising again. And what this like means is not necessarily like a straight uptrend for silver, especially silver really. This one, like, as Russell, has been trading since 1985, he'll tell you kind of can flounder around a lot, whip around a lot. And so what we see is a set of stacked opens. I'm seeing up here at this 47 level, that would be basically bullish target of interest, right? Kind of the goal for silver is to be continuing to make more of these cycles or these uptrend longer cycles than we are the downside, right? That's kind of the end goal for silver. In terms of that long-term post, let me look at the silver future, and then I'm going to let Russell talk and rest my voice for a second. I think we were doing wave 100 daily, if I'm not mistaken. Correct me if I'm wrong. Actually, let me look at this real quick because I want to make sure we're looking at this right. Just give me like 45 seconds. Okay. It's wave 200 daily. Okay.
On a side note, I used to trade silver futures. I don't trade them as much anymore, but I think back in the 80s it was around 750 the price, something like that.
Sounds
And I
about right.
remember everybody's like, "Oh my god, it's going to $20." I took forever to go to 20. Yeah, if it moved 25 cents in a day, it was a good day.
Yeah, exactly. And so that's like
Yeah.
silver. So we talk about gold's variance. Silver, I would say, even more so. Like if we just let me check. This is looking back till 2001, right? And so we'll put a linear graph on here, right? We can check the price of silver, right? And so you can see like it's in terms of gold holds its value a lot better than silver. Something also, this is what idea for Russell, I guess. We can look at the beta of like silver to gold, like that correlation. You could basically do SI divided by GC. Like, so that's something we could look at from a fractal perspective eventually. I think I put somewhere that ultimately, like, what we're looking at is not necessarily like silver to like go to X target in dollars, but rather to begin outperforming gold on a long basis, um, meaning that the value of silver to gold is going to increase over time. And so that could mean necessarily that both go down in dollar denomination, but the actual value of silver to gold can increase. That was kind of the crux of like what we're looking at, is that I think the value of silver to gold is like undervalued in a sense, like relatively. The question is like, when does it become to like an idea of fair value? It's anyone's guess. We're looking at the wave 200 daily, and what I see here immediately is something kind of like a parallel sequence almost to this wave 200 sequence. We can see that at this present moment and kind of above to like the $60 level, that there's like kind of these points where potentially these like monster parabolic rallies can start to fluctuate, flatten out, right? If we look at the amount of change from this period to this period, which is like from here to here, is the same amount of time from here to here, roughly, right? Gold is also undergoing that pastry, or excuse me, silver is also undergoing a general pastry squeeze effect, meaning that we're at a potential lull. But what this really means to me is that I don't think necessarily this is going to be like a silver, is going to match this curve back down, like how you can look often like it does that frequently. Like Russell can tell you looking back to the 80s, like if that's a you could think of that as like a frequent occurrence over multiple time frames. It doesn't stick into a trend the same way as gold does, just from a qualitative perspective. And so what this I think though is kind of silver's at a point of a lull. Are we in the parabolic rally state from our volatility? We're not primed for it right now. It's the opposite, right? The volatility indices and kind of the variance of silver needs to contract a little bit in order to provide that next leg up. But what this implies to me is this kind of same thing as gold. Like if we're at a point where we might have like a couple weeks to a couple months of stagnation, right? I don't think we're at a point where the dollar is necessarily going to necessarily rise super strong, right? What we were looking at is more of kind of a 5 to 10% increase maximum in the dollar. It's very low instance that we get beyond that. And you can look back at my dollar futures post kind of for reference of like looking at the strength and weakness of the dollar. What this implies to me is basically like on this next leg up in metals, meaning this next surge of debasement, silver has the opportunity to outperform gold here, head towards this open state. We had a variety of different opens, kind of like, in the $80 area. But is that a guarantee? No, it's not a guarantee. Like ultimately, what you need to be doing is right. If you're talking about long-term positions, it kind of goes back to that point we were talking about a premium and discount. Like now is not the time to be, aping into long-term positions on metals. Really, it's the time to be kind of waiting on the sidelines to buy that. As Russell says always, right? The golden time to buy is in the golden zone, right? We are at a point of relative like expansion in our standard deviation. We're at a potential crest here, right? Looking to the left. And so in reality, like what this leads to is a couple of different things. We can see this example, right? This crest could just be a flat line before we get another leg up, right? It's unknown, it's potential. I think we're at a potential point of like a similarity, meaning that, in terms of like looking to the left, we're not necessarily at a point of massive over like price time, like quote unquote speed, right? We're not at a necessarily like outlier point. Actually, if you look to the left, we're actually only one instance looking back at this 179 where we kind of fully flattened out before, going back to the golden zone. And so what this leads to me, I think there could be another leg up in the standard deviation, thus the volatility of silver, kind of going in circles. Hopefully that makes sense. If there's any, Lem, do you have any questions kind of on what I was saying there? Hopefully that explains my perspective.
And it looks like Big Gun there, like on that monster rally, that low.
Yep.
It looks like traders right now are looking to that little pin low, to the right a little bit,
Yep.
as the resistance.
Absolutely.
Where the
Absolutely.
dotted line is at intersects. Yeah, it looks like they're looking to that little hook down
Yeah.
on that monster rally. Yeah, right in there is the resistance right
Yep.
now. So that lets us know, unless it can break above that high on the far right, our current wave up, could be pinned right in there. Have to break above that to really, like you say, like if that could happen, man, then we'd have another leg potentially. And another thing in this, like, look how the volatility is increasing. On the left side leading to that monster rally, we kept getting the higher highs and higher highs. I mean, we had some low in there, but eventually it blew out, that blow off top. And it looks like it's overall with time starting to repeat that process again. Like it's going to have a blowout again at some point in the
Exactly.
future.
Yes,
Yeah.
exactly.
So
And so this is a 15,000. This is looking back to 2001, right? And so as Russell's saying, we're kind of in this where if you want to think about a general, path of action, as Russell's saying, where we are in this point of higher. Does this mean necessarily go like silver is going to like? Does this correlate exactly to the price? No, you can see that typically in the highest volatility events, almost always are these downside moves. But this means the overall kind of, as Russell's saying, like we're getting to this point of more volatility for silver over time. And so the rate, like kind of the volatility of silver right now to gold is already like I would say, a higher variance, but that gap can widen as well as kind of what we were talking about earlier, the premium of silver to gold is going to start to kind of come close. I mean, not to parity, obviously. Like I'm not saying silver is going up $4,300 an ounce, but it'll get a little bit closer, right? Maybe to that $80 area, right? And if we got to the $80 area, right, and gold is not going up to $6,000 an ounce, right? That's a pretty substantial increase in that gap. So it's like you could create a lot of different strategies that are basically like long silver, short gold in a way, but it's not you're not shorting necessarily in like a denominated dollar term, right? You don't need to do that necessarily. I'm kind of rambling here. Any other, Lem? Hopefully this answered your question. Any other questions or kind of things of concern or anything? If you want Russell to analyze something, share his screen. Speak up. Forever hold your peace.
Hey, this is Antone. I have a question about gold for
Yep.
or GC equals F rather. That 40 was it 45 4750 open state for wave 215,000 days load. What would have to happen for that open state to not be so probable for the
You
future
said let me see. You said
for GC
GVC, correct?
for GC equals F gold?
Oh, GC equals F. Okay, let's check
Yep.
that.
Yep.
Okay, so 4750. What would have to happen for that not to occur, for
Yeah.
that probability to fizzle out? Really, it's
Yep.
going to require our dollar futures to have a above average surge, in my opinion. If we're not, if that is not in the cards in the future, then it's kind of almost natural that gold is going to like go go towards that. The dollar every single day is eroding in value, and that's something that it's kind of hard to quantify because we think of the dollar as like a base unit that is like 1 equals 1, right? But really the dollar's value is eroding every day. And it's hard to like what do we measure this against, right? If you're a particle in a vacuum, like you could either be moving or not. Like it's impossible, forget the exact, or excuse me, oh my gosh, exact specifics, but you basically cannot know a particle's position, its velocity, accelerate. Like you cannot know all three of these things at the same time. And so it's kind of a similar truth to the dollar, meaning we can measure it, like for example, DXY, dollar futures, those measure the dollar against a basket of currencies. They're not measuring it against commodities or like metals, things like gold or Bitcoin, whatever. So that's a consideration to have, right? We need to, in my opinion, I think if we would see some strength in the dollar, both in that against other currencies, kind of like maybe some fizzling out of like in my opinion, reckless like fiscal policy they're doing, where they're basically, buying a bunch of high interest credit cards, right, to pay off debt like very rapidly, right? If that kind of changes course, that's where gold, institutionally, I think institutions are going to begin to risk off and have confidence in U.S. Treasuries again, right, to buy. But really, without that, resurgence in confidence of Treasuries, like the world is naturally on a path of like getting rid of the treasury and kind of reverting back to you know a reserve standard of gold, in my opinion, right? That's my opinion. It's not a fact. And so what does that mean for 4750 is that it could take longer to get there, but it is in the cards. And I would say in that wave sequence, it's definitely absolutely feasible to get there. If you look at that, I think it took an extra 500 or 600 days, right, comparatively to where we are now, but we got there without an L sequence, right? And so that's what you want to think about is like that kind of timing is like we're talking about, realistically, like at the minimum, like until end of Trump's term for all these things to play out because that's going to be our treasury regime and kind of the regime of where the dollar is going. So that's kind of what I see. Maybe Russell, if you want to chime in, speak on that, that would help.
Yeah, the debt is a problem in the U.S. So until that gets under control, the metals and stuff will really continue to perform overall. I took Big Gun's graph and I drew in that volatility curve just visually, just kind of drawing some lines. And you can see how these swings, these kind of pendulum swings occur. And we have diminishing volatility. So we just came out of, on Big Gun's graph, we just came out of this big volatility swing, this pendulum swing. So now the volatility is going to start to probably compress down. And then, at a certain point, we're going to have another event to break out of it. But it kind of gives you an idea, a guideline. And you can see the cone shape as we're talking about the pastry squirt. It's like kind of like the pastry tube, and then the frosting, explodes out of it. You can see kind of how that works visually. So we're re-entering that phase again. As they're talking about fiscal restraint, you can see how well the market works when the government's closed. I mean, I think it's been shown that the market works the best when there's no legislatures in session. There's all the Congress people are off. And it's because, when they start dinking with regulations, they're dinking with programs, it creates a level of uncertainty. So participants in the market aren't sure what's going to happen. And as soon as that cloud lifts, there's nobody in Congress, then there's more clarity because programs are in place. The government provides a lot of stimulus to our economy. So that becomes solidified more so. And right now with it closed, it's a little more solidified because, they're not in there dinking with stuff, dinking with the economy, picking winners and losers, basically. Underneath Biden, it was kind of like solar, green energy. Now more like investing in nuclear, back to fossil fuels, which we're very dependent on. So, but that debt is really, that creates a shadow over the economy, and then it allows the metals to perform. There used to be, so back when I started trading metals back in probably about 87, I think, when I first started really trading silver and gold futures, there was this kind of unwritten law that gold and silver would trade at multiples to each other. There became a point where it was very decoupled. Gold really moved away from silver, and now begun, as he's pointing out, there's a little bit more of a coupling. Silver's always been considered an industrial metal, for use in gadgets, electronics, and systems. And gold has kind of been considered a hedge for inflation. So, if the world, right now, Trump, they're trying to do this thing where we're trying to bring more of the precious earth metals, rare earth metals, into the U.S. fold and not be relying on China for the magnets and all this stuff. And, silver would be, of course, wrapped up into that. So as they push that, try to protect that, of course, it really helps the metals, So copper is a leading indicator. So if we want to know how the economy may be performing out in the future, kind of look to copper futures and see if they're holding strength or not. Because that's, of course, a very big industrial metal used in electronics, washers, dryers, TVs, cars. And, so right now it looks like we probably have a little bit of volatility in front of us based on this cone. And then it's going to probably diminish a little bit more. And then, moving into the future, I don't know when, but then we're going to have this expansion again, this pendulum swing. So, but metals longer term, they haven't really been, gold never performed really well. It's only been recently. It's performed pretty decently. It's been a lagging asset. But copper, so we have trusts. One of them I have in fuels because until we can come up with some revolution in the U.S. For mechanical power other than fossil fuels, that's pretty much where the economy is going to lie. So Some of them I have in fossil fuels, our longer term stuff that's 20 and 30 years out. Metals really haven't messed with too much. They've been kind of lagging. Now they finally had picked up. It's taken forever, 20 years, 30 years, really. To
Yeah,
come
it's
back.
funny how you can get almost like a decade of action in like the span of a couple months, you know?
Yeah,
That's really how it's been
yeah,
since February.
yeah, yeah. Gold's done well over the last few years now, but my God, there was a dry period. I was trading silver futures. I was like, are these things ever going to move?
Yeah.
Bucks in a day.
Yeah. Especially they're very expensive too. I mean, their tick value is very expensive, like even more so like gold is comparatively like a lot less expensive. So got like yeah, silver has got to be that's got to be a headache when it's pretty dry.
Yeah, yeah, it is. Yeah.
Yeah. I was also going to say the last thing. It looks like based on your kind of pastry squeeze cone that if basically if we're kind of in that process, it seems like our downside moves that we've had in the past couple days maybe are kind of coming to an end. It looks like we have a little bit more room to the upside within that cone for both gold and silver. Um, and kind of just like the near term, right? The H sequences have more magnitude potential than the L sequences. Um, I don't know if you see the same thing, but I kind of am seeing that.
Um. Oh, I'm sorry, Big Gun. Can you say it again?
Yeah, you're good. I was just saying for gold, silver, within the pastry squeeze envelope, right? It looks like in the near term, gold H sequences have a little bit more potential for magnitude than kind of the L sequences. It seems like there's a little bit, yeah,
I I totally agree. It looks like we've got to have a counter long trend, to kind of fill out that cone that's being created right now. I kind of just drew them by hand. So it looks like
absolutely.
we'll probably have a big up at some point, you know. And it'd be great if the options didn't have such horrible time decay at times, because then you can
Yeah,
kind of camp out into some of the options, and when you get that hit, you'd be like you're having a windfall. But yeah,
yeah,
doesn't
especially its
affect you that
expiration
much.
structure. GLDs, that weird like Monday expiration, it kind of almost throws off. I feel like it just makes, I don't know, I feel like it just makes it a little bit harder to like kind of pinpoint. Like I wish it was either a week just only Friday expiries or it was, oh, zero DTE every day. Like I wish it wasn't only, three expiries a week. That's just me.
Yeah.
I'd like to discuss ConocoPhillips more, if we can, please. We talked about it before, Russell. Um, OPEC just decided today to pause production going forward. So, in the small waves and the larger waves, everything's looking pretty good. Earnings is on Thursday. Um, it's something I'm still researching and possibly might take a play on.
Yeah, if OPEC, sometimes, so I've traded oil for a long time because I also
Hmm.
started trading oil futures back in the 80s. And like the consensus was kind of like you take tongue in cheek what OPEC would say, because those guys sometimes they would say stuff and it would
Hmm.
never come true. So they might be like, oh, we're cutting or we're adding, and they wouldn't really cut, they wouldn't really add, you know. So generally, it was always based on price action. So we really wouldn't pay too much attention to OPEC, what they would say, because those guys are so self-serving. And they, with Trump, he may be able to get them under control a little bit on what we want, but by and large,
Hmm.
they kind of like march to their own drummer. So I know on, that ConocoPhillips, if that could have broken out, we could have seeked some higher open states. but so far it's kind of just on the long side. It's really languished. Really hasn't done anything.
Mhm.
But I know, yeah, I was checking futures oil, and it looked like it was starting to get some long side coming in. Let me see. Yeah, so maybe it'll, Trump's really been trying to get, because he understands his stuff, so he's really trying to get fossil fuels to behave, because they go into so many different things, and he
Mhm.
knows that's highly inflationary. So I know he's been trying to get that tamed down. Now on 1015 on CLF, on our light sweet crude, we had a K assignment on Friday at the last minute. We'll have to see if that has some follow through. And on Brent 1015, let me see if it's the same thing. Yeah, so Brent had a little more aggressive move. Looks like coming off a K. Really messy. Yeah, so I'm looking at Brent crude, BZ equals F, wave 7 daily. And we're right up into that average percent on what I'm looking at. I can post it.
Mhm.
So looks like, if it's going to break out, it's going to be around this area. Let me post what I'm seeing. Yeah, so I just posted in the chat what I'm looking at. 65.20 is that vector. Price action's kind of squeezing up into that average percent line. But really over this is a 200 day. So really over that 200 day, only had one really good rally out of that average percent.
Gotcha.
Yeah.
So it's not so
So
probable
my
it
fate.
continues.
Yeah, the trend has been for it to pull back. So
Mhm.
if that happens, we're gonna start getting below 65.20 again a barrel. And then we go down to the 63 line. And I bet you Trump's up there like he's like, oh, if you guys try to keep oil down, I'll give you some leases and probably doing backroom deals. Try to get oil
Yeah.
under control.
The problem is once crude goes under 60 a barrel, these companies start going unprofitable. Most of them do.
Yeah, it's
Besides
hard. Like,
casinos.
yeah, my family, like in our state, we have a couple oil wells. My family came out of Texas, out of Lubbock.
Gotcha.
So we still have mineral rights. Yeah, so we actually get some oil money. And back when, what was it, 15 years ago? And they started, so out of the few wells we've got, they went dry. Well, not totally dry, but if they don't pump so many barrels a day, they just cap them. So they
Mhm.
capped them. And then about 15 years ago, I was getting calls from a couple of the companies and they wanted to frack them. So we signed some deals for fracking. Yeah. So over there, so they fracked a bunch over there, not only ours, but a bunch of other ones. And they started pumping pretty good again. So some of those over there, depending upon the contracts and the companies we have, they can come in below 60 and still be okay. Back in the 80s when I used to trade oil futures, it was like $23.27 a barrel,
Jeez.
so 65 seems like crazy. But
Yeah.
some of them can be okay, some not. The Middle East, they have a lot of artesian, so they can be okay over there and just turn on the spigot and it just like flows oil. But yeah, Trump, he's a smart guy, so he knows they got to probably stay in the, and he's probably telling everybody, hey, look, try to keep it in the, lower 60s,
Right.
and then I'll do you guys favors.
But that number is really rising because $60 profitable level is rising historically because the labor And just the overhead with labor companies nowadays, it's getting more expensive because the cost of living's up. So
Yeah.
payroll, goes higher. So that 60 profitability numbers really going up as inflation goes higher.
Yeah, it's definitely creeping up. I know on those wells they were fracking, the few we had, they were looking at about a $1.8 million investment, I think, to frack them
Hmm.
each one, and up to 2 million. And so when they're doing it, when they give us the contracts, they're like, "Well, we don't know what it's going to produce," and
Hmm.
they're like, "We're spending the money," and so it does. It's like they can, in addition to labor and stuff, they can go out and wildcat. They can go out and frack a bunch and just waste money hand over fist. It's funny because everybody's like, "Oh, big oil makes so much money." Well, during COVID, the contracts went negative.
Right.
It was unheard of, and I couldn't believe it. I wasn't trading at the time, but I was watching them. I was like, "Holy crap, these things are going negative." That means that the producers of oil have to pay somebody to take the oil off their hands when it goes
Right.
negative. So
Futures
when
went
it's
contango.
positive, yeah, it goes opposite. So when you're producing, somebody has to pay you to get your oil. When the futures, when the contracts go negative, you have to pay somebody else to take your oil, which is crazy. And I remember one of the dudes that was one of the oil companies went unglued. He's like, "This futures market's rigged against us, and I've never heard of having to pay somebody." What happened was they were putting all the oil in tankers and storage, and they ran out of storage, and there was nowhere to go. And I remember at that time, we have a farm and we also burn diesel. I remember at that time, Pioneer Fuels, that's one of the fuel companies we use, they were calling around shopping diesel at 25 cents a gallon
Jeez.
to take it because they're like, "We have nowhere for it to go and we're
Oh
out of
man.
storage." They're just giving it away. Because my wife and I, for example, we would drive up to Scottsdale from Casa Grande. There was nobody on the road. There was no airplanes flying. Like everybody was experiencing, everything just stopped. And so, yeah, it was pretty crazy during that time. But I
Right.
would imagine if this follows through with Brent crude, we should dip below 65.20 because every time we get into that average band, we seem to pull back, and that's where we're at now. So we'll have to see if that follows through. That would be a short side opportunity if it
Hmm.
stalls out around the 65 area. And sometimes even using USO on the put side, sometimes I've done 200, 500, 1,000%. It's hard to get 1,000 out of it, but you usually get 25, 50, 100% out of those put
Wow.
contracts.
Are
I have
those
to see
options
where the
pretty
premium.
liquid? Like a lot of
Yeah,
activity?
USO's not too bad. Yeah, it's decently liquid, nothing great, but it's kind of okay. I haven't checked this setup right now, so this setup would be a pullback to like the 63 area at a
Hmm.
minimum, based on this BZ graph, wave 7 daily. If we can break the 65.20. And two, the airplanes probably are putting a little bit of pressure because they're not using as much jet fuel at the second, from what I encountered over the weekend when we flew. So it's lightening up a little bit, maybe.
Hmm. Yeah.
Yeah, I'd have to check the
Hmm.
options. Let's see, 65.20. I'll check right now.
Yep.
Let me see USO.
Looks like Conoco hit
USO's
a
more.
K assignment on wave 3 and 7 Friday. Same with Brent.
Yeah. Yeah, kind of goes a little bit of a slower mover, of course.
One thing I wanted to say regarding crude is this kind of pattern we can see that develops. There's two patterns actually. Number one, kind of that commodity like pastry squeeze pattern, right? These like waves very clearly that develop. We can kind of see crude right now is relative to the downside at least is very squeezed, meaning that there is an expansive downside move brewing, in my opinion, like that we can see kind of looking past. I've made boatloads of money trading these open state sweeps that occur over the course of a day or two, these massive, variances. And so we can kind of visualize this upswing, downswing using our option analyzer. We can actually see very clearly that typically, right, almost always that these massive upside sequences get followed by these downside, like these equal length downside, or the opposite, right? These substantial downside flushes get followed, right? And so what I see here is that there's kind of something brewing, like to kind of balance it out. We're due for some kind of sequence that takes us down here in a short amount of days, like 3 or 4 maximum. And so that's what I would say is like we were actually trading like kind of this idea in QQQ Live last week. We only got like I think 200% or 150, somewhere in between 150 200% out of it. If we had of course gotten this downswing, it would have been on the order of 1,000%. And a good example, like I've traded this to the upside as well. Over the summer, I got really lucky with like a blessed USO position, a couple bucks to several $100s. Remember talking to Russell about this, like we're going to open up beautifully tomorrow, seeing that. And so you can kind of trade, this crude oil, right? There's obviously, oil related companies, but we also have USO, which is an ETF that we have data, IV data on, all stored in the database. And what is USO doing? But it's actually, holding a position of, cash and crude oil futures, right? CL futures. And so you can look to that as well for some positioning related stuff on there. We've kind of gone over that in the past with like USO. We get these, deep, oftentimes, like we had this last week actually, which is what the whole basis was for me putting up that 73 put in the QQ live last week. Oftentimes after these big upswings, there's like a lot of, in the money put basically added like onto the next week's expiries. Like I've seen this pattern like this time, I saw it this time, right? And this is how we played out following that pattern, right? Um, Russell's showing in the chat USO would need a 3% haircut for this $70 put to work. Let's check out USO because I do want to kind of take another swing at that. I feel like last week, I mean, we made some good profits off that, but it wasn't what I like to. It wasn't, USO can do 10,000% if it wanted to. So, what I'll see here, number one, there's an absence of deep in the money put exposure that we would like to see that would kind of hold price, suppress it to the downside. We actually see the opposite where there's a lot of out of the money call exposure. Where look, these strikes here, like 75, 73 is where you would expect to see that exposure, that pattern that I've seen. And so what this tells us is that above, this massive call wall, basically market makers are bidding USO. USO ETF guy is, they're buying CL futures to maintain an NAV. And so that could potentially mean like there's another upswing in the future prior to this downside open state sweep kind of looming. We have positioning here. We at the $70 strike. You can actually see, there's a substantial, out of the money put position below this. We call it for next week. We have a 71.55 OI pivot, right? So below that, obviously, there's potential for the downside. Market makers are net selling USO stock to hedge, right? So we can grind down in that scenario. It really looks like the big, 2 levels of interest to ignite an open state sweep, meaning that this $70 put can go to potentially $500 to $1,000 a contract. What we really need is 2 things: A, to maintain below the average strike put here, and B, we need to monetize this massive 67 put interest here it looks to me that if we can monetize this is what you can kind of see it correlates to this last line of defense here at kind of below the 67 area. It would allow us to get to 64, 62, 58. And so obviously, at the 64 level alone, you're getting roughly, $5 and change of intrinsic value. So a little over $500 guaranteed value here, plus IV, of course. Even more so, you're getting over $700. Here you're getting, a lot more. So that's really, kind of what I'm seeing from this group. I've played this many times, and I've seen it play out and kind of regretted not, buying a boatload of just, some lotto puts. You can use the Periscope for that. I would highly, highly recommend using that because my biggest play, I think it was something like $5 or $6 to like $600 a contract on USO in the same week. I think I was telling Russell about this. This was over the summer with the whole Israel Gaza escalation, whatever. And so it was during that time. I think we almost hit a limit up in crude oil. If I remember correctly, we almost hit a limit up. But yeah, so anyways, sorry for rambling. Hopefully that helps a little bit.
Can you show the Periscope for USO?
Sure. So as we know, right, Periscope it's going to have a set of MM data for like looking at USO has the Monday, Wednesday, Friday expiry, and so we'll see. We need to make, or I guess it's only showing the Wednesday, Friday contracts in here.
Okay.
So we're looking at the Wednesday contract. Let's check bearish. Right, it's not offering a lot of premium because our floor is at this 70.6 area. Um, so you can kind of see on like the Russell's put is out of the money at the floor. So we would need to really break that 70.6 floor and those other values I gave to kind of usher in that. Alternatively, right, we have our ceiling at the 77 area. So that's kind of like talking about the dual potential, right, of either A, we get the continuation of this, I call it a whipsaw pattern, where we basically repeat the H sequence magnitude on the downside, potentially over a different length of time. Or, it could obviously have that alternate pattern we discussed where we continue the upside sequence. It also looks like this PML, this 73 PML, is going to be pretty relevant for the next week. So, kind of below that, we've got a shot at getting to the floor. I'd really say that let's check out. We didn't check out the USO volatility index. So let me check that real quick if I can find it up here. Trying to remember what the symbol is. Look it up real quick. Give me like 2 minutes. OVX. Okay. So we'll check out OVX. And we'll just see where it is. Right. OVX is actually a lot different, if you'll notice very quickly, to our commodities. We are at almost the end of the pastry squeeze, right? Meaning that we're actually, there is a massive move looming to Russell. If you see something different, let me know. But to me, this implies there's actually a pretty substantial move looming for crude oil implied volatility in the future. So a whipsaw of some sort. You can kind of see like these various things here. So that would generally mean like crude oil is due for substantial variance either way. Likely I would in my what I would like to see is that whipsaw play out. Basically, we get that substantial downside move, and that would allow a good buying opportunity for crude oil, kind of like a potential like floor developing over a course of several weeks maybe. But this is what we see on OVX. We're clearly in a range here developing. It looks like we're kind of at the end of a pacer squeeze. You'll note that we are in a green macro trend, meaning crude oil volume is rising. We will continue to be in a green macro trend if we stay above this orange vector here. You can see various examples of what happened if we're in green macro trend, right? Generally, it leads to a spike in crude oil implied volatility. So it would mean that for a long options trader like what we do, we're actually potentially encountering a not necessarily a discount, but rather like there's going to be a point in the future of excessive premium that we can kind of capitalize on in the meantime. Hopefully this helps.
Does, thank you.
Well, our sessions is almost closing in on 4 hours, so I think it's time to kind of, organize some final questions and comments, things of that nature. So if anyone has like any persistent questions, even if someone thinks it might be a dumb question or whatever, ask away. Now is the time, or else we're going to kind of start to wrap it up. I'll give it a couple minutes for people to type in chat, or just, you can obviously unmute yourself and all that. All right, okay. It looks like we're not really getting any questions, which I always love to see that. It means we did a good job here, not making things harder for people. Um, so I kind of will just say to Russell, if you have any kind of like final comments or anything, take the stage.
Not not really. Appreciate everybody showing up and participating.
All right, perfect.
So
All right. Well, thank you everybody for joining and spending the last 4 hours with us. Hope you guys have a good afternoon. As always, make use of this voice channel whenever you guys are, wanting to. You don't need any moderator, owner, or anything. You can always start your own session. And we'll look to kind of announce another scheduled session sometime in the next prior to Thanksgiving. So we'll let you know more information on that as we have it. Thanks again, guys, and take care. Thank you again, Russell, as well, for hosting alongside. I really appreciate it.
Great. Thank you,
yeah,
guys.
thanks for explaining all this stuff out.
Anytime. Take care,
All
fellas.
right. Thanks, everyone. All right. Bye.